Is my screen visible?
Yes, Prof.
Yes, Prof.
Okay, so let's look at how to actually solve DTA questions. All right. So let's look at how to actually solve DTA questions. Now, when you are dealing with exam questions that involve DTA, I get on either passive or active income. Okay, you must consider the tax policy involved in answering the question. You look at how taxing rights are allocated, how the income is calculated, if there's any calculation, okay, or if you can't get how the income is calculated, look for any double taxation reliefs, okay? Then draw conclusions about the implications of whatever has happened. Now, this is the full structure for getting, if it's 20, you get 20 over 20. All right. And they have wanted students to follow these 4 steps, but most people don't even know that there's a framework. So for me, in all my courses that I teach, over 40 courses that I have taught, I always use frameworks to teach everything. All right. So what do you do when we say tax policy? Let's say you've gotten a question on employment, okay? So far as Ghana is involved, talk about the nature of the income, that this involves employment income. I get it. If there's a treaty between Ghana and the United Kingdom, the treaty between Ghana and United Kingdom, it shall apply, right? This is covered under what? Article 15. They mark it. Now, if there are any domestic law provisions that relates to the tax policy, that employment income rules can be found under Section 4 of the Income Tax Act. Are you getting it? And according to the Income Tax Act, all gains and profit from employment are considered as what? Are taxed, right? As employment income taxation. Are you getting it? Then you now analyze the facts of the case. And always, if there's a DTA, you always have to state the Section 998(2), right? That is where there's a conflict between the DTA and the domestic law. The DTA shall take precedence over the domestic law. Is it clear? Does it make sense? If you know any case law and decisions that have been arrived at by the courts, you can always bring it in. They give marks for that. But if you don't worry yourself. But this is one side students always forget. And I don't want you to forget that. Is it clear? Especially this one, where the DTA takes precedence over the domestic law. There's always marks attached to that. Is it clear?
Yes,
Is
sir.
everybody okay?
Yes,
Did you get
sir.
what goes into tax policy? So always when it comes to tax policy, this is what we are actually what looking for. Please don't ever forget this. I'll be okay. You being able to do this alone tells you that you are serious and you are ready for game. Now, when we talk about how taxing rights are allocated, this is where students don't understand. Now, let me break it down to class 1 level for you, okay? The main objective, the main reason why we enter into treaty is to actually distribute the taxing right of income between the 2 states. So, country R, which is the resident state, which taxes you on your worldwide income, and country S, which is your source state, which is where the money arose from. Now, you see, because these 2 countries, you are dealing with 2 different countries, that is what creates double taxation. We call them the connecting principles or the connecting factors of double taxation. What did I say? I said we call them the connecting what?
So I'll see you in the
Principles or connecting factors.
Yes. So before double taxation will happen, there must be an overlap between the residence principle and the source principle, right? Meaning you made money somewhere, but someone else is saying that you are his child, right? Do you get the idea? You made money somewhere, somebody is saying that you are his child, so you also need to feed her. So that is it. That's how it works. So both of them will end up taxing you. Do you understand? So we are saying that because of this principle, countries enter into DTAs to try and see which country will tax the income fully when there's a DTA. Now, if there's a DTA, we allocate taxing right for 4 types of income. What did I say? We allocate taxing right for what?
4 types of income.
4 types of income. Income which the source state has full taxing rights. 2. Income which the resident state has full taxing rights. 3. Income which the source state has limited taxing rights, meaning both of the 2 states are going to share. And income which the state involving the what? The place of effective management has the taxing right. And this one exists for only Article 8, but now is a contracting state of the enterprise since 2017. But if you still use this, you still get it. Do you get it? So these are the 4 ways we allocate taxing rights. Taxing rights can be on a shall basis or be on a may basis. Let me explain. If the DTA say shall tax, all right, shall tax, it means that it is primary taxing right. If the DTA says may tax, it means it's a secondary tax. It means may or may not. I shall slap you. I just say, oh yeah, the so life. I may slap you. I just say, maybe I will slap you. Usin yinabe tutu. Meboa.
That's
You get that
really,
idea?
yeah.
I shall slap you means it is life. It will come on. The clash shall happen. Is there no confidence behind it? Is it 50-50 or is definite? The clash shall happen. Is it 50-50 or is definite?
It's definite.
But if I say the class may happen, is it 50-50 or is definite?
50-50.
50-50.
50-50. So if the DTA says shall tax, it means that it is primary taxing right. If it says may tax, that means you may reserve the right to tax. Do you understand? You can tax it, but you may not tax it depending on the arrangement. And these are basic rules students actually have to understand. This is how this is what you use to answer the questions. Hmm? So put this down, put this 4 down. It's very critical to your exam. And this is where I'm going to now give you the techniques on what to write, how to pass. You understand? Yeah.
Prof, please, among the 4, why don't we have income which R also has limited taxing right?
If S has limited taxing rights, it means that R has full taxing rights but can give you a credit for it. R can never have limited taxing rights because that's where you came from. You don't bite the finger that feeds you. That's the whole idea behind this. If Ghana didn't give birth to you, Ghana was safe. He gave birth to you, and you were now able to live as a human being and grow and even go to the UK. Why should we give Ghana limited taxing rights? If war was in Ghana, would you even get a chance to go to the UK? So they give that respect to your resident state, no matter where you come from. So R can never have limited taxing rights. I hope what I'm saying makes sense.
Yeah, it does.
Good.
And is it also connected to the worldwide principle of
Of
taxation?
course.
Is that also a reason why?
Don't worry, I'll come there. The worldwide principle
Okay. Are you
works
able to explain the 4?
I am now coming there. Say yes,
The
step by
4, the
step.
principle.
Pamucho
Okay.
mepa. Say
Okay.
yes, step by step. Me so dear trotters. For now, I assume you don't know anything in international tax. See, when I started, did I assume that any of you had knowledge? I'm asking the whole class. Or I started from scratch.
Why?
Hello? Did I assume
Why?
any of you had knowledge in international tax or I started from scratch?
No, Prof, you
No.
started from scratch.
Good. So I assume you don't know what that means. So I will take you through. So don't worry. That's why I'm here. Yeah, Rema, you were asking a question.
No, I was responding to your question, bro.
Oh, okay. That's my TO. If you have any question, you can ask her.
But mommy asked him.
Please have you written it down? I'm coming right now. I'm coming. Let me
Wow,
go.
we are blessed.
TA,
Get ready for my questions. TA.
I said,
That's so bad, man.
whose voice is that?
TA.
I will behave.
TA, please. I have a question.
Okay, bring
Hey.
your question on. And then I'll be say, Apofi now the culture on.
Please, let's continue. So I said we have income which S has full taxing rights, income which R has full taxing rights, income which S has limited taxing rights, or income which both states have shared taxing rights. So if S has limited taxing rights, it means both states has what? Shared what? Taxing rights. Does it make sense? Does it make sense? An income which the state involving the place of effective management has a taxing right. So let's look at income which S has a full taxing right. Okay, so for instance, let's use immovable property as an example. I said let's use what as an example? Immovable property as an example. Can we go? Can we go?
Yes, sir.
So we are saying that income derived by a resident of. So anytime you see DT and you want to read, right, and you feel you'll be confused, if we read it this way, income derived by a resident of a contracting state from immovable property situated in the other contracting state may be taxed in that other state. Does it make sense? It looks a bit confusing, right? True or false? True or false?
True.
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 I'm very tired,
Less
so you should be
confusing.
giving me. You should be giving me what?
We'll
You
not
should
go and
be giving me
unmute. That's why we delay.
You get it? So what you do is you just replace it with two different countries. So I'm a Ghanaian, so I'll replace it R with Ghana and replace S with another state. Let's say South Africa. No, South Africa, Omunja Omasem, Italy. So income derived by residents of Ghana from immovable property, including income from agriculture and forestry situated in Italy, may be taxed in Italy. You see, now it makes more sense. That's how we read DTAs. Let me go again. Income derived by a resident of Ghana from immovable property, including income from agriculture and forestry, situated in Italy, may be taxed in Italy. It means that immovable property is solely taxed where? In the source state. It means the resident state will not tax it. But however, if they are taxing rights, you see, it depends on the treaty, then they may have that may tax. Are you getting it? So S has the privilege to tax the income accrued in S. And R also has a taxing right on income for its residents. Do you get it? So R may apply a measure of elimination of DTA. What does it mean? It means that in some treaties, even though this guy will tax it, when you bring the income to your country, they will tax it and now give you what? A measure of elimination. That's through credit or exemption or deduction. Do you understand what I mean?
Yes, Prof.
Yes.
Good. But who taxes it first? Who has the primary right? Who taxes it first? The
The
source
source state.
state.
Source state.
Good. So what incomes do we tax it like this? That's what I wanted you to just have an idea of. One, immovable property. It is taxed where it is located. Director's fees. If you're a director, okay, and then you are in Ghana, but you're a UK citizen, and a Ghanaian company pays you director's fees, board fees, allowances, it will be taxed where? In Ghana. Is it not Ghana you were employed?
Yes,
Is
Prof.
it not Ghana you were employed?
Ghana.
Yes. So if a Ghanaian company is paying you, then Ghana deserves to tax that money. Because even per our domestic law, it is gains and profit from that employment. Do you understand? Then when it comes to income of sportsmen, artists, and entertainers under Article 17, they are also taxed in the state of performance, which is the source state. Source simply means where the money arose. Makes sense? Same rule. Now, if you have a PE in another country and you made business income, that business income will be taxed where the PE is located, the source, which is still source state. You see, the same S has full taxing rights. Do you get it?
Prof.
Did you get the articles? So, immovable property, who taxes it first? Source state. Director's fee, source state. Artists and sportsmen, source state.
Source
Business
state.
income through the PE, source state.
Source
Makes sense?
state.
Good. So even if you don't remember anything, this summary should help you. Do you understand? So you know exactly what to say. All right. Can we go?
So,
Nice. Now let's look at income for which the resident state has full taxing rights. So let's take an example. The first one I'll talk about is royalties. Now, royalties in Ghana and beneficially owned by resident of UK shall be taxed only in UK. Or let me turn it the other way. Royalties arising in UK and beneficially owned by a resident of Ghana shall be taxed only in Ghana. So which state is taxing royalties here? Is it source or resident state?
Resident state.
Resident state.
Resident state. Thank you. So with royalties under the OECD, I'm using the OECD model here. So with royalties under the OECD model, it's a resident state who taxes it, right?
Yes.
Now, this is when it is not effectively connected to a PE. But if it is effectively connected to a PE, then it shall be taxed where the PE is located as business income. So PE, that's the basic rule across all other articles. Does that make sense? So which articles actually works like this? 1, capital gains. 2, royalties, pension income, student income, business income that didn't come through a PE. It will be taxed in the resident state. Are we okay?
Please, what about the capital gains that has to do with the one they sell the aeroplane?
That has to do with the one they sell the aeroplane.
The one from the alienation of like
Alienation of aircraft. Hey.
help me. Ama, easy.
Oh, yeah, wild though. Yeah, break. Yeah, your fault.
Oh, is he gone?
It's
I'm on
there.
the
Hello, sir.
You did that, Pam.
So you see the capital gains, they have one that relates to immovable property, have one that relates to movable property when it comes to P, and then there's one that has to do with the alienation of say air
See,
transportation.
Pacho, you know why?
Prof is not here, right?
Are they here? One can hear into the mean. This is movable property, right? So it will just be taxed in the contracting state where the aircraft or the ship is operated, or where it is resident. So it started in 2017, right? The contracting state of the enterprise. Do you understand? So if I operate the aircraft or the business in Ghana and I sold it, it will be taxed here because it's movable property connected with the operation of that ship or aircraft. Do you understand?
Oh, okay.
Yeah.
So don't want to follow the source rule or what? Resident.
Not necessarily source rule, but mostly resident rule. But then, see, the activity of aircraft, where you locate it is where you incorporated it, which makes it like the resident state. Do you get it? It's like a special treatment.
So the Article 8 is a resident rule.
No, that one doesn't really get taxed. You can say Article 8, yes, is related to resident because in Ghana, like this, all our DTA says where the ship owner is resident, where the ship owner is resident. Do you understand? Or where the aircraft owner is resident. Yes, so it's sort of related to residence.
Okay, thank you.
Yes, but you must do all the tests where the directors are located, where the books are kept. You have to still do the test. So they can give you a full Article 8 question where you have to do all those tests. Do you understand?
Yeah.
Yeah. Okay. Please, are we okay? Can we go to income which S has limited taxing rights? Can we go to income which S has limited taxing rights?
Yeah, Prof.
Yes, please.
Can you throw more light on the business income, not through the PE? In what situation can the business income be derived by a non-resident person without going through the PE.
Okay. Now, assuming I have a partnership in another country, okay, not every country taxes partnerships as transparent, fiscally transparent entity, right? Do you understand what I mean?
Yes.
Yeah, go ahead.
And also, assuming I run a business with somebody out there, I get it, and I'm not actually the owner of the business there. It is just an allocation from business that came to me. Do you understand?
No, in fact, I'm looking at a situation where the non-resident can derive income from the location that, from the jurisdiction that the P is located, and yet since the P was not used, that income
Remember,
can be taxed in there.
P is only the threshold that allows the source country to tax your business profit, right? So, for instance, if I'm resident in the UK and I sell accounting software to customers in Ghana, right? I have my customers in Ghana. I make sales to Ghanaian customers. I earn profits from Ghana. I have no
Sorry,
office.
please, can you
I
go
have
to
no
the
office.
previous?
Please let me finish. I'm coming.
Okay.
So I have no office in Ghana. I have no branch in Ghana. I have no employee or agent in Ghana who concludes contracts on my behalf. Then I do not have a PE in Ghana, right? But I have business income connected with Ghana, but it is not a PE. Emmanuel, do you get it now? So yes, this is business income, but there's no PE. It's just trading with Ghana, not trading in Ghana.
Oh, okay. I
So
see.
it's a business income, but then was it conducted through a PE?
No.
No. So according to Article 7, this income I getting will be taxable only in what? That state, that is Ghana, if there's a PE there. So assuming we had an agent who were selling the accounting software, then we'll tax all in Ghana. Makes sense? And then we'll exempt it from the UK tax. So you ask yourself, is there business income? Yes. Does a non-resident have a PE in Ghana? No. Therefore, Ghana would normally tax the business profit under Article 7. But where you ask yourself, is there business income? Yes. Is there a PE? Yes. Then it will be taxed rather in what? In Ghana. Emmanuel, are you okay?
Yes, it's clear now.
Please, the person was asking the question. Where did you say I should go?
Prof, please, I want to see the previous slide, the source one, so that I can. Okay, thank you. That's all. Thank you.
You're welcome. Okay, so where were we? Now we are going to the last one, which was income for which S has what? Limited taxing rights, right? So example will be what? Interest, dividend, royalties, fees for technical services. Are we okay? Now, interest arising in Ghana and paid to a resident of maybe UK will be taxed in the UK. Do you get it? That's what paragraph what? 11, Article 11, paragraph 1 says. But however, interest arising in the contracting state, right, which is maybe Ghana, may also be taxed in Ghana according to the laws of Ghana. But if the beneficial owner of the interest is a resident of UK, the tax charge shall not exceed 10% of the gross amount of interest. So you see here, there are two people taxing it. Okay. So usually interest, dividend, royalties, they are taxed in this way. Are you listening?
Yes.
Are you listening?
Yes, sir.
We will tax it at a lower rate in the source state, and then you will bring it to your normal country. We'll tax it fully, and then grant you a credit. And this is where that withholding tax rate in the DTA apply. Do you see how it works? So assuming I made $10,000, are you getting it? In the UK, in the form of interest. Do you understand? UK can tax me at a maximum of 10% per the OECD model. Do you understand? When I bring that $10,000 to Ghana, Ghana will add it to my income and tax it fully, and now grant me a credit under Section 112. Do you see how it works? But
Yeah.
only if I was the beneficial owner. Who can repeat what I said? Who can repeat what I said? Who can
You
repeat what I
said if you earn interest, provided Ghana has DTA with UK. So if you earn interest in UK will tax you at 10%. Then the
It's a
income
maximum of 10%.
maximum of 10% there.
Yes, that's per the OECD model. It can
Yes.
dwindle, it can change.
It will be subjected to tax payment in Ghana fully. Then you'll be given credits under Section 112.
Yeah. So that's how it works. Does it make sense to everyone? So this is what we mean by S has limited taxing right. You saw that the source state had limited taxing right. It could only tax a portion of the income. That's what we call the limited taxing right. But who had full taxing right is the resident state.
The
But however, we'll
resident
give you a
state.
credit. You see how it works. So we call it income with a shared taxing right. Both of us will share the taxing right. So passive income, when you want to understand passive income in the DTAs, you must first understand. I hope you can see my screen.
Mm.
You must first understand.
The screen is blank. It's white. It's just white at my end.
I don't know why. Yeah, so you must first understand beneficial ownership. Okay, so we are now going to understand beneficial ownership. And you see, understanding treaty shopping, beneficial ownership, and the concept of treaty shopping is very, very important when it comes to dealing with what? Passive income. All right, why is that so? When we say beneficial ownership, I don't even need to explain properly too much. You see, yesterday we looked at economic ownership and legal ownership. Do you remember? What was the difference? What was the difference?
One has
Yeah,
the title.
you said
The other
the
just
beneficial owner is
Not beneficial owner. Yesterday, I didn't talk about beneficial
Yeah.
ownership. I talked about economic ownership when we talked about intangible. And we said these are the people who have the risk and rewards of ownership, right?
Yeah.
So these are the people who enjoy the actual benefits of whatever has been done. Mebwa. But you may be the one who just have the legal title, right? Just the legal title. Maybe it's your name that is on the share certificate. So the legal title, and I gave an example that if I have a car, right, my name is on the car document, but I gave it to my brother. It's my brother who uses it, who repairs it, who does everything, who is actually controlling the car, who receives economic benefits from the car. It's my brother. So my brother is actually the beneficial owner, not me. Do you understand? It goes with the principle of substance over form. So we consider the commercial substance over the legal form. Do you get the whole idea? Do you get the whole idea? So there are various scenarios that help identify beneficial owners. So look, assuming, let's go to section 59, subsection 3 in Ghana. It says that where a resident company A, are you getting it, directly or indirectly, owns another company B, at least 25% of its shares, right? In Ghana, if B pays dividend, what happens to the dividend? The dividend will be exempt from tax. Are you getting it? The dividend will be exempt from tax. Are you all following?
Yes, Prof.
For this provision, is it not lucrative? Assuming there's a US company here, US company, can he enjoy this exemption? Can he enjoy this exemption?
No.
No. So do you know what he will do? He will intentionally come and acquire what? He will intentionally come and acquire A, right? Let's say he buys 100% of A. He owns A now. A now buys what? Let's say 40% of B. B pays the dividend. On the face of it, who has the share certificate of B? It is A, right?
A.
This is the guy who bought and has the share certificate. Good. So on the face, it looks like this guy is the owner. But in actual sense, everything will be shipped to this guy in the US. Meboa. And he is now the beneficial owner, the actual person enjoying the benefits. Does it make sense?
Yes, sir.
Yes.
So beneficial ownership is the one who is enjoying the economic rights of ownership, not the one who is just on the face, the one who is hidden. Does it make sense?
Yes.
So because you must understand passive income, because they use passive income to plan a lot, then that means you must understand treaty shopping. What do I mean by treaty shopping? Now, if let's look at the same scenario, right? That maybe DTA between UK and Ghana, okay? The dividend in there is at a lower rate. Let's say that if dividends are transferred, maybe it's at 5%, right? Somebody sees that this is a very good provision, right? But he's not part of those countries' DTA. Okay, so let's say this is a US guy, the same way. He's not part of the two countries' DTA. So do you know what he does? He will intentionally what? Come and acquire this company. Then this company will now go and buy. So that if this guy pays dividend to this guy, it will now be transferred to him. But is he part of the treaty?
No.
No. So this is considered treaty abuse or treaty shopping, right? He's just shopping provisions in the treaty by setting up a conduit entity. So this UK company is just what we call a special purpose vehicle. It's just used to transport the dividends to him. Does it make sense?
Yes, Prof.
And that's exactly what they gave last night. All right. Let me see. Let's see. I just want to show you something, whether you really get the whole idea. So I'll give you a framework which works magic, no matter the kind of passive income question that you've gotten. But you can't do passive income without talking about treaty shopping and beneficial ownership. And you must even tell the examiner that even though treaty shopping it's not defined in the tax treaty, you want to talk about it. There's marks allocated to it every time. That's how these things work. All right. Passive income, where are you? Computer, don't slow down now. We beg.
For mixed study.
Please hold on, The software I'm building is slowing down. It's taking more of my memory. Ouch. Oh. Please hold on, I'm coming.
Okay, we are holding.
Okay. Please, whose background is that? It's quite noisy. This is what came last night. And good. This February 2026 question 2. You can see. So dividends and treaty shopping. Daska Company Limited, which is Daska, right? A Ghanaian resident company is a wholly owned subsidiary of Gaska, which is the group. So anytime you spot group scenarios, yesterday I told you anytime you see group scenarios, what should come into your head? Anytime you see group, what is the first thing that should come into your head? Persons in controlled relationship. You remember? Do you remember? All the
Yes.
time.
Yes, sir.
PE should come into your head. Subsidiary PE. The next thing that should come into your head is what? The arm's length principle. Do you remember? Yes. And tax avoidance. Always multinationals, this all they are concerned about. So anytime you get a question, these are the things you should think about. And immediately you start thinking about this, you get a lot of things to say. Anyway, that's just by the way. So let's see. So far as they are saying that who is owned by who, you can draw the structure. Always draw the group structure. I said always draw the what?
Structure.
So it says the group owns who? The group owns 100% of who? Of Daska. No be so. And where is Daska located? In Ghana. Meboa. Good.
Yes.
Now it is telling us that the group is in Canada. No be so.
Mm.
Good. Now, in 2024, the group incorporated Tasca in Mauritius. Anytime you see them set up something in a tax haven, some place like Mauritius, it should tell you that this guy have bad mind. So here they went to set up what? Another what? Vehicle in Mauritius, right? Which is what? Tasca. And look at what happened. They transferred all the shares in Tasca to what? To Tasca. No be so? In that year. So now that means that who now owns Tasca? Who now owns Tasca? Who now owns Dasca? It is the Mauritius company now owns what? Dasca. Because he sold all the shares to this guy. No be so? No be so? So indirectly, this guy controls this guy. You understand? Now look at what happened. Tasca only has one employee in Mauritius. Does it make sense? That means this one is just a special purpose vehicle, or what we call a conduit entity. It means that it has just been set up just to transport dividends or interest or something. Do you get the idea? So they are hiding the true beneficiary, the one who is actually enjoying. And who is actually enjoying the rights? Who is actually enjoying the rights here?
The group.
The group, the Canadian company. So look at what it has. It says similar arrangements have been replicated across all the subsidiaries that the group owns worldwide. So look at the extract of their share transfer needs. Notwithstanding anything contained in this agreement, the dividend paid by Dasca shall all be transferred fully to Gasga, the group. Can you see that? So this is what they have. So every dividend that they made would have been transferred to the group. And Dasca Company Limited paid 1 million dividend to Tasca. So that means that this guy transferred $1 million worth of dividend to Tasca. And now look at what happened though. If he transfers it to Tasca, it doesn't end there. You know, there's a DTA between Ghana and Mauritius. Now look at why that guy did what he did. Ghana Mauritius DTA says dividend paid by a resident company to a resident of the other contracting state shall not exceed 5%. So this Canadian company is only interested in this 5%. That's why he intentionally bought Mauritius company and Ghana company. So that when the Ghana company transfers to Mauritius, it will be taxed at 5%, lower than the normal 8%. And then when you see Mauritius Canada DTA, when the dividend paid by a resident of a contracting state to the resident of the other contracting state shall not also pay what? Exceed 1%. So this guy has set up a structure like this. Canada company here has what? Acquired what? A Mauritius company here. And the Mauritius company has acquired what? A Ghana company here. So that if the Ghana transfers the dividend to be taxed at 5 instead of 8, and then Mauritius will also give it to him, it will only be taxed at 1%. So in that case, he only pays tax of 6% of the 1 million instead of the 8% of 1 million, saving about 2% per what? Per dollar. Do you get the idea? So you see what he has done. But in actual sense, since Canada is not a beneficiary, Canada is not what? A resident in either of these states in the Ghana Mauritius DTA, I get in it. The commissioner per some processes is going to what? Stop this guy from enjoying those rules. And we'll come and look at those rules for you to understand it well. So the treaty itself has some rules that stop people from taking advantage of some of these things. So beneficial ownership always go with what? Treaty shopping. And with this kind of question, you still have to talk about what? So the question asks, what is the nature of the tax avoidance scheme employed by the group? Noting any tax benefit that may arise. What is actually happening? What is happening? What do we call it? Treaty
Abuse or treaty
abuse
shopping.
or treaty shopping. Then to do that, to explain the arrangement, you must still be able to explain what treaty shopping is. You must still be able to obtain explain who beneficial owner is before you can get that 8 marks. It is a constant rule. And this is the real reason you are doing international tax, to be able to identify these things. Are we okay?
Prof,
Yes, please.
Yes, considering the question, the second paragraph where we have relevant detail provisions. Mauritius, Canada, dividend paid by a resident company of contracting state to a resident of the other contracting state shall not exceed 1%. That is a clear characteristic of a tax haven. Is it mandatory we know countries that are tax havens?
Oh, it's not very mandatory. Know about 2 or 3 B. Well, Mauritius is one of them.
How about learning the characteristics of tax haven?
Oh, of course, you
That-
need that one. Hey, that one there, if you don't learn it, it can take you by surprise. That's why yesterday I was saying you must know tax savings and preferential tax regimes. You remember?
Right.
Yes, Prof.
So, at the be there, you can never ignore them. So, you must know them like the back of your hand. Okay, so who had a question? Who has a question? Or we can now go to the framework for answering passive income questions.
Yes, Prof.
Okay, so to understand passive income question, Krano, you must still be very good with PE, right? So when it comes to PE, they ask you questions on various paragraphs in PE, okay? So what candidates should expect in exam? So PE questions will often test your understanding on specific paragraphs of Article 5 and other connected articles. So as I told you, PE, so far as any article is connected to PE, that income will be taxed where the PE is located, right? So paragraph 1 of PE is the general definition. A question can just come on paragraph 1. The paragraph 2 is the examples of fixed place PE. So you should know office, branch, place of management, all those things. Oil and gas well, mine, quarry. Then construction PE, all right? So construction PE is the only one that in our laws in Ghana has a limitation or the number of days to become a PE, 90 days. Do you know that? Yes, but in the OECD model is 12 months, and then the UN model is 6 months to become a PE. And also the UN model includes supervisory activities and assembly activities. Now, this is where it gets interesting. The exclusions from a PE. So anything that is auxiliary or preparatory in nature. When we say auxiliary, how would you know whether something is auxiliary or preparatory in nature? You must first look at the core business. And how do you know a core business? You must actually look at what? The FAR that we looked at in transfer pricing, the functional analysis, the functions, assets, and risks that are taken by the business. That will tell you what the core business is. So if they tell you that this guy is into manufacture, design, and sale of shoes, right? What does it tell us? What is the revenue producing activity? Is the sale of shoes. True or false? True or false?
Yes, Prof. True.
So if I just acquire raw materials to produce the shoe, does it give me any revenue? No. This is just something
No.
that prepare the shoes for production. I get it. If I just do some calligraphic design on the shoe in another state for myself before I sell the shoe, what is it? It's just to prepare. What if I just package the shoe to sell? Are you getting it? It's just what? Auxiliary, helping to promote the sale. If I do adverts just for my shoe, but not sale, just to get buyers to buy, it is just what? Auxiliary. So preparatory is before the production. Auxiliary is to what? To help in the sale. Do you understand? So if I'm selling shoes, anything that helps me to actually sell the shoes, generates money, becomes what? Business of the enterprise. But anything that is just helping to either prepare the shoe for production or getting it ready for sale is what? Preparatory or auxiliary. All preparatory or auxiliary activities are not taxable because they do not create a PE. Why? Because no revenue happens. Nothing happens for us to even tax in the first place. But people take advantage of it. For instance, see somebody have given me goods to just store in my warehouse. Am I selling? No, I'm just storing it. Preparatory auxiliary. If I'm maintaining somebody's stock in my warehouse, preparatory auxiliary. If I'm just an insurance company comes to your country and all they are doing is scanning the market and collecting information about people, have they sold anything? Have they sold anything?
No.
So should it create a... No, it shouldn't. Do you get the idea?
Yeah.
Are you getting it? So this is where people sat down and say, you know something, we will outsmart the tax authorities. So this is what they did. They create businesses who are what? Cohesively related. Are you getting it? Who perform complementary functions. But they forget that the revenue authority will see them. So let's see how this works. And this is where it gets very interesting. I know that most students, if this thing comes in scenarios, they can't even see. So that's where I come in. Let me help you to understand this very well. Cohesively related operations. Now, this one is an anti-avoidance provision. What did I say? It's what?
An anti-avoidance provision.
Yes, it is. People are trying to do tax avoidance. So it's an anti-avoidance provisions under Article 5. It came under paragraph 4.1. Okay, paragraph 4.1 is in the commentaries. Okay, so it's an anti-avoidance provision which we actually call. So those people do business fragmentation. They put the business into fragments. Okay, so we call it anti-fragmentation rule. What did I say?
Fragmentation rule.
Why do we call it anti-fragmentation rule? Now let me explain. See, if multinational companies, right, decide, let's say my parent company is in the US, okay? Now look at what this parent company does. He sets up multiple subsidiaries, right? In the same place, in the same country, or multiple locations in the same country. So these are controlled parties, or simply what? Closely held enterprises. So when we say closely held, if you see the word closely held anywhere, it means subsidiary. Okay? When you see the word closely related anywhere, it means you are talking about what? Group what? Members. So they are just related. Do you understand? But subsidiary is closely held. So whether closely related or closely held entities are found in the same location. Let's say this is Ghana, right? So look at this. Company A is found in what? Tema. Okay, it can be the same location or multiple locations in the same country. If company A only does what? Procurement, right? It buys raw materials. Look at this. Procurement of raw materials. Are you getting it? Then company B, procurement of raw materials and what? Machines, right? Then company B now does what? Production. Are you getting it? Of the goods. Please, are you all following? Are you all following?
Yes, Prof.
Production of the goods. Then company C now does packaging of the goods, right? Then company D now does adverts and taking orders, okay? And now submit these orders to the parent company in the US, and then the parent company now submits what? The final invoice to the customer to pay. Now, if you come to Ghana, were they generating any income in Ghana?
No.
Were they generating any income in Ghana?
No,
So they're not
Prof.
generating any income, right? So if GRA walks to any of these guys and say, you are doing activity in this activity, in this transaction, let's say this is a UK company, right? Because without DTA, anything they are doing will be taxable. Okay, so these exemptions from PE that preparatory and auxiliary we are seeing. You see that preparatory and auxiliary we are talking about? You see that preparatory and auxiliary we are talking about? It only exists when there's a DTA. Without DTA, GRA will tax everything you do in Ghana. We don't care. It's only the DTA that breaks these exemptions. Without DTA, this thing doesn't exist. Do you get the idea?
Yes, Prof.
Good.
Yes, sir.
Now, if you just interview each and every one of this, whatever they are doing, does it generate any revenue? No. It's preparatory auxiliary in nature. Can you see? Can you see?
Yes, sir.
Yes, Prof.
Individually. But if you put them together, don't they form a cohesive business activity? Don't they feed into each other?
They do.
And one single operation no match him. That's what I mean.
Yeah.
Is it not one
They
single
do.
business that they've divided it? You buy machines and raw materials. You submit it to this guy. He uses it to produce. When you finish, it goes to this guy to package. When you finish, this guy will now take it and now do advert and take orders. Then the order goes to the parent. Then you now take payment. So this guy is just hiding this. But actually, or actuary, there's a PE. Do you get it? This is what we call fragmentation. So the full business has been fragmented. So we use the anti-fragmentation rule to say that, you see, you are trying to act smart. But when this thing happens, one, when they are what? Closely related or closely held entities in the same country, right? If they are found in the same country, either same place or what? Multiple locations. Do you understand? If they are found either in the same place or multiple locations in the same country, here it was not the same place, but it was rather what? Multiple locations in the same country. Maybe one was in Tema, one was in Accra, one was in Kumasi. Are you getting it? And whatever they are doing forms a what? It forms complementary
Yes.
functions, right? So complementary functions that lead to what? A cohesive business activity. Okay.
Okay.
So when this thing happens, the commissioner will say, you know something, you are trying to what? Bypass our tax laws. Do you get it? Therefore, you have a PE in Ghana. Therefore, you what?
In Ghana.
You have a PE in Ghana. And do you know the funny thing? Students hardly identify this anti-fragmentation rule. And most questions always have it when you see subsidiary in a case, your eye should open and see if the activities the subsidiaries are doing in the case have this rule in there. Interesting, right? Let's take a question.
Yes, Prof.
Did that make sense?
Yeah.
Are we sure?
Prof, let's look at the question. Maybe that will help.
Or are they for you? Why are you the fear?
Nah.
Why are you the fear? If I say I did for you, I did for you. All right. So let's see if you can identify something here. Good. Why is this question behaving like this? All right. So let's see. Popular Dairy SA is a manufacturer and a distributor of dairy products. Okay. It is headquartered in the Netherlands. Where is it located? Headquartered where? Netherlands. But what does it always look for? Functions. You remember, even in transfer pricing, we are always looking for what? Functions. We are always looking for group entities. That's your secret to passing international tax. Look for functions, assets, risks. Look for what? Apart from functions, assets, and risk, I say also look for what? Group entities. Because those are the people who mostly bypass tax laws. A small business and Hano, because tax goes to Yanisha. But multinationals, they pay huge taxes. And those people are very tax planning conscious or tax avoidance conscious. They're always looking for loopholes. So in every case that CIT usually gives you, one entity owns the other, another entity owns the other. It's always like that. So now your PE questions will not come as just PE. They will always be mixed with passive income and anti-avoidance. That's how international tax is actually supposed to be examined. So let's prepare very well. So it's a manufacturer and distributor. If you are doing transfer pricing, what is this? Is it not functions?
Yeah, functions.
These are functions. So it manufactures and distributes what? Dairy products, milk and the rest. And where is its headquarters? Netherlands. So it is simply a resident of Netherlands. Good. Now, Denver Distributors Limited. Dina Distributors. This guy also does distribution. So Denver Distributors and Pentax Procurement are 100% Ghanaian resident companies. But they are all 100% owned by Popular Dairy SA. So did we see closely held entities?
Yes.
Yes.
Okay. Are they in the same locations or multiple locations in the same country? Are they in multiple locations in the same country? Are they all in Ghana?
Yes,
Yes.
they are
Yes,
all in
they're
Ghana.
all in Ghana, and they are all subsidiaries of Popular Diary SA. That is, we've spotted what? Two of the conditions. Now, let's see if their activities form a cohesive business activity or they are complementary functions. Now, it is saying that they are all owned by Popular Diary. Now, Denver Distributors possesses a warehouse in which Popular Diary products are stored for resale to customers. Now, warehouse where you store goods, which are later sold to customers, is it preparatory auxiliary or is an actual sales activity?
It's
Preparatory and
preparatory
Yes, it's
auxiliary.
auxiliary.
preparatory and auxiliary because you are not actually selling, you are just storing the goods, right? So on its own, it doesn't do anything. But let's look at something. Pentax Procurement undertakes purchasing functions on behalf of Popular Diary SA. Are you getting it? So it buys those goods. Then this guy will store it in the warehouse, ready to sell to customers. Then the sales and purchase orders received in Ghana by the two subsidiaries are now sent to the parent in Netherlands for approval, and contract will be signed in Netherlands. Does it look like something that one company would do normal chichema? Nah, that's what you have to think. Does this thing look like one business that somebody would do, that they've divided it into pieces?
Yes, sir.
Yes.
Prof.
Yeah. So these things are complementary functions. So it's like one buys, right? So who does that? Pentax buys raw materials, buys inventory, right? Then what happens? Then Pentax will now give to what? Denver Distributors.
Denver
Do you get it? Then Denver will now what? Store
store it.
in the warehouse, right?
Yes,
And also take what? Take orders.
others.
Then what happens? They will
Sent
now
to
submit the
diary,
order to what? To
diary product.
Popular Diary SA. No, be so.
Yeah.
Yeah, so they'll now send it to Popular Diary SA. Then Popular Diary SA will now sign contracts, right?
Yes.
And then now instruct Denver Distributors to move the goods to the customer. Assuming all this thing was in one building, it's not a full business. But individually, they are preparatory and auxiliary in nature. So they are using that to fool the tax authorities. So mostly when you start seeing subsidiaries in cases, you have to start opening your eyes. Okay, I'll also teach you how to answer PE questions very well. Okay, because PE questions, they are usually long cases and you get confused, overwhelmed. Meboa. No, be so? Yeah. So I'll show you how to deal with such questions. Don't fear. Now, they said the GRA is maintaining that Popular Diary SA has a PE in Ghana and as such should be taxed in Ghana accordingly. But Popular Diary SA argues that its subsidiaries in Ghana are independent agents and that the functions they perform are preparatory and auxiliary. And truly, to what they are doing, is it not preparatory and auxiliary? They have a point. But however, when you look behind the scenes, is this just preparatory and auxiliary or it forms a cohesive business activity?
Exactly.
Forms a cohesive business activity.
So it's like GRA is saying that, okay, you people, you think you are smart, eh? So you are a chartered tax practitioner and you are being consulted by the Commissioner General to advise him on the disagreement between GRA and Popular Diary SA. Do you get it? So prepare a briefing note to the Commissioner. Are you getting it? And what? Determine whether Popular Diary SA has a PE in Ghana and give reasons for your answer. So my question is, does Popular Diary SA have a PE in Ghana?
Yes.
Yes.
Then now you go to the why. Why does he have a PE in what? In Ghana. So the thing, no, it's not giddy giddy. It's about understanding the rules and then just feeling free and explaining the rules in the way you understand it. Does it make sense? So let's say that, assuming you went in there, right? You went to the exam and then you didn't really know where to start. Okay, let me show you how to get free marks. Not free marks, but cheap marks. What did I say? Not free marks, but what?
But cheap marks.
But cheap marks. Now, what did they say? Let me just say, assuming I'm in exam, I'm faced with this question. I don't know what to do. I'm stuck. What do I do to get some marks? It's 16, right? They said establish whether Popular Diary has PE in Ghana. So straightforward, what I will start to do is that immediately I'll say what? Permanent establishment. right? Are you following? So always use keywords. I say always use what?
Keyword.
Always use keywords. So far as you know something about the topic means you have a chance of passing. Even though you don't understand the scenario. What did I say? So far as you know something
Even
about
though you
the topic,
don't understand the scenario.
even if you don't get the scenario very well, pick keywords and talk about them. Pick keywords and talk about them. I saw the word permanent establishment. Don't I know permanent establishment? I do. So straightforward, I'll underline and say what? In accordance with what? With Article 5, a permanent establishment is a fixed place
Mm.
through which
Business and people.
the business of an enterprise is wholly or partly carried on. So, are you getting it? So remember, point, explanation,
And proposal.
then what? Evidence. Didn't I teach you this?
Evidence.
This is how we
You did.
answer questions. So, the business of what? Of popular diary essay will create a PE if it has a fixed place at its disposal in Ghana for carrying out its business. And what is its business? Its business of, I'm just using the definition of PE to relate it to the case. Its business of what? Manufacturing
Manufacturing
and
and
distribution of
of
dairy
dairy products.
products. Tell me, assuming you didn't know what to say and you even said this, wouldn't you get some marks?
We should.
Oh, be honest.
We shall.
Good. Now,
We
don't end
shall.
there. What else do you know? You know preparatory and auxiliary activity. True or false? That's something you also. Then you come and say, this will exclude activities that are preparatory and auxiliary in nature, right? You can say that this excludes activities, are you getting it? Which are what? Preparatory and auxiliary what? In nature, right? Good. Then you can come and then you see, okay, this guy was doing purchasing. Purchasing is preparatory or auxiliary. So you can just say purchasing function, or you can just use the name. It doesn't matter. So maybe I can say Pentax what? Pentax procurement. Do you see the idea? Then I underline. You don't really need to be an expert. Rules, no Nima. Just look at something that looks like the rule you know, and just you are going on. You understand? So what would I say about Pentax procurement? Let me check. So Pentax procurement, double, like pick and act, right? Straightforward. Pentax procurement, just copy everything. Performs or undertakes all what? Performs all purchasing functions, right? Purchasing functions of the group, right? Of the group. Are you getting it? Which I'm right. Right. Of the group which constitutes preparatory activity, right? According to Article 5(4). right? However, if they complement activities in the group, it can trigger the anti-fragmentation rule. Makes sense. So it's like most of you, you know the provisions, but you get a case, you don't know where to start. It doesn't matter where you start. Anything you identify, underline. Did you get the whole idea? Are you learning the style? Into wo hwehwɛ nneɛma a wonim about PE, unwupɛ na watro bibi afa ho. For instance, what other thing did I see? Independent agents. I can just take independent agents and just what? Underline. And say what? An independent agent, right? An independent agent is what? Is working in the what? The ordinary course of his business, right? Ordinary course of his business, and does not what? Create a PE status, right? Then you can now go with the case that since Popular Diary said they are independent agents, upon your own analysis, you think they are not independent, right? Because of so and so and so. Do you see how we do it? So it doesn't mean that if you get a case, hey, let me take another case. I'm just showing you something. I want a longer one. Look at Centrum. Look at it. Oh. Straightforward. Like it says Centrum is a company resident in a country called Condola. The Copos Limited is a wholly owned subsidiary of Centrum. Immediately you see wholly owned subsidiary. You can just write wholly owned subsidiary. And then what? Underlined and talk about subsidiary PE. Is the manufacture and distribution of expensive what? Medical diagnostic equipment. What is that? It's a function, business of the enterprise, right? You can just say what? Distribution and manufacture. Then you underline, then you say that this constitutes the business of the enterprise. And according to Article 5, a PE is what? Where a fixed place it at your disposal for carrying out the business of the enterprise. He maintains a warehouse in Ducati. Warehouse in Ducati. You can just say warehouse in Ducati. Then you underline, then you say warehouse is preparatory and auxiliary in nature, and from the case, da 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 da. Are you getting the trick? There's no, you can even pick a whole paragraph and use as your point and explain. Exam is strategy. And if you want to pass, don't waste time. Anything you think you know, relate your knowledge to what they have said in the case. And that's what the small point. Than leaving it blank, you would have gotten more than half of the mark. That's the secret. Hmm? Are you getting it? Are you sure you get me?
Yes, please.
If Ghana is involved there, no cry, it's simple. So Ghana is involved, then you make reference to the Ghana provisions, right? And especially the section 98, what? Subsection 2, and say where the DTA conflicts with the domestic law, the DTA shall take precedence over the domestic law. So since there's also provisions in Ghana, the provisions and the DTA shall take precedence over the rules of the Ghana tax law. That's all. I'm coming.
Hello?
Okay. Please, did we get the anti-fragmentation right? Are we okay?
Yes, Prof.
So did you see how to deal with cases? It's not about knowing the whole case. Even if you know bits and pieces, for some bits and pieces, no, for answer question, no. Did you get the idea? So can we move? So I hope now we are okay with it. We are familiar with the anti-fragmentation rule. Can we move to another thing? I believe these things you
We
should have
shall.
learned it already. Good. So now after that, we need to understand what the dependent agency PE. Now, the dependent agency PE is simply where you have what? An agent, right? Who solely is remunerated by you, okay? Carries out instructions on your behalf and habitually enters into contract, right? So he habitually what? Carries out contract on your behalf. Now, listen carefully. If I take your employees, do they meet this definition? Your employees or staff, do they meet this definition? I'm asking the
They do.
class. They do.
Yes,
Your
Prof.
employees purely are remunerated by you. They enter into contract for you. I get in it. And they are they take money from you and they carry out instructions on your behalf. So look at the nature of the case and the employees involved, whether they are directly doing what the parent was instructing, then they can also become your dependent agents. Does that make sense? I hope it's starting to make sense.
Yes, Prof.
Good. Now, that is what will bring me to subsidiary PE. There's nothing called subsidiary PE. I said there's nothing called what? Subsidiary PE. But however, a
Subsidiary.
subsidiary or a group member can become your PE when he is acting like a dependent agent. What did I say? When he's acting like what? A dependent what? Agent.
Defense agent.
Are we okay? So, for instance, what are the rules for subsidiary or parent PE or whatever you call it, like a group member becoming a PE? One, where he acts as a dependent agent for you. Do you understand? So let's say if I have a subsidiary, I sell shoes, and this subsidiary sell wine, but he went outside his business to what? To sell that wine, to sell that shoe on my behalf. It means that it becomes a subsidiary PE, right? Two, where he gives me a fixed place, right? So a fixed place where the subsidiary, I getting it, provides a fixed place, I getting it, to carry on the parent activity. To carry out the parent activity. Do you understand what I mean by this? Do you understand what I mean by this? So if the subsidiary is giving you a place for your staff to come and work, are you getting it? And sell the wine in Ghana, but you are in the UK, it creates a PE because the subsidiary now becomes your dependent what? Agent. Does it make sense?
Agent.
So a subsidiary in itself is not a separate PE definition. But if the subsidiary acts as a dependent agent on your behalf, or he has a fixed place at your disposal, a fixed place that is at your disposal to do your work, or simply, most questions will tell you that a corner office in the subsidiary, right? So mostly your staff want to come to Ghana, right? But the subsidiary gave them a small office which is effectively within their control, right? So a place that is effectively within your control, whether it is owned or rented, are you getting it? Becomes a place at your disposal. So it creates a PE. Does that make sense? Does it
Yeah.
make sense? Good.
Yeah.
Don't forget this. So immediately you start seeing subsidiary, immediately you see a subsidiary in a case, what should come into your mind? Immediately you see subsidiary in a PE case, what should come into mind? Two things. What are they? One,
What did I-
anti-fragmentation. Meboa. And two, dependent agent. Meboa. These are the two things that always, when you see subsidiaries in a PEK, start identifying or start investigation, anti-fragmentation, dependent agency. And that's what scores you the marks. The thing is, it's not that they are difficult. When you understand the rules, you don't need a full thing. You identify bits and pieces and just talk about them. If you feel you don't know the case at all, check. Was there a warehouse? Underline. Talk about preparatory and auxiliary. Check. Was there a subsidiary? Talk about these things. Check. Was there construction? Talk about construction PE. Do you get it? So always explain first, then lead it to where in the case or what you think it means. And that alone, that bits and pieces, you get marks for it. Even though it's not like somebody who is an expert, it tells us you have bits and pieces of the knowledge or the articles required. Is it clear? I hope some people's confidence level are coming up.
Yes, Prof.
I'm only hearing one person. Oh. I only heard one person.
Yes,
Prof.
sir.
Yes, Prof. Yes, Prof.
Baba.
Yes, sir.
Okay. A strategy. Do you get it? Now let's come to independent agency. Now, independent agency is not, it doesn't create a PE, right? So look, if MTN, okay, MTN does data services for everybody. So MTN is acting in the ordinary course of their own business. True or false? True or false?
True.
So assuming I use a MTN to do data services, does it create a PE? No, it doesn't create a
No.
PE. It doesn't create a PE. True or false?
True.
But however, if MTN goes outside its ordinary course of business to do something for me, which was never intended to be done by MTN, then it can create a PE. Let me explain. MTN does not do database support for anybody at all. Then MTN finally does database support, which is my work on my behalf, and starts getting customers. Is MTN now not my dependent agent? Even though he works in his ordinary course of business, didn't he go outside the ordinary course of his business to do something for me? So has he not now become my dependent agent?
Yes.
So then it moves from independent person to now become a dependent agency PE, a DIP. Are we okay? Did we get it? Did we get it?
Yes, sir. Yes.
All right. So then let's go into the tax challenges of the digital economy. Who can tell me what tax challenges the digital economy has brought and why we think it's a big challenge? Who can tell me what the tax challenges of the digital economy are and why can they be a big challenge? Yes.
Prof, I think there is difficulty in determining taxable presence.
There's difficulty in establishing taxable presence. I'll take it. Makes sense. Yes.
Also, base erosion.
Yes, I'm listening. Is that all? Hey, I have people on the call. Oh.
Base erosion and
Nexus
profit.
They can also trade within the country without a PE.
Okay. You can also trade within the country without a PE.
Nexus difficulty in identifying the nexus.
Difficulty in identifying nexus or connection with our state. I'll take it. Yes. Yes. Please, this thing, be very careful because it's possible it's coming for 10 marks. where they ask you question 4 to explain the tax challenges that the digital economy poses. Question 4A. Question 4B is a question on pillar 1 and pillar 2. The A, where did it come from? The tax challenges of the digital economy. Everybody on the call can be able to write. Or?
Yes, Prof.
Bana went to do any award.
Fortunate by this time.
Somebody says, say, I'm listening.
Well, difficulty in
What else?
establishing fiscal pressure.
Hey.
Difficulty in identify their
Establishing
revenue to
fiscal
tax.
pressure.
Yes, of course. So you see, the digital economy, why the digital economy poses a threat is now everything is online, right? It's difficult to even see whether the person is trading in your country in the first place. If I have a website online, people from all other countries can access the website. True or false? True or false? Because people from all places can access the website. Which country do I actually exist in? You can't tell. Do you understand? So it's difficult establishing the connection with other countries, which we call what? The nexus. Do you understand? 2, unclear income characterization. We cannot really tell what kind of income it really is, right? Because if I get income from 3D printing, how do we classify it in our laws? Do you get it? You cannot properly characterize the income. 3, it makes the PE status difficult to actually codify, right? So people use this to avoid the PE status. That's also 1. 3, it makes VAT and withholding tax collections very difficult. Remember, true or false? True or false? True. So it makes VAT and withholding taxes very difficult to collect. That's also another challenge of the digital economy, right? And most people even use the various web way to mask their income because you can't even see them. Most people don't even have an identity online. It's just their income that flows. So the tax authorities even find it difficult to spot those transactions. Do you understand? And also the digital economy has brought a lot of tax fraud through romance scams and other things, right? Which is making it difficult for the tax authority. This thing, you don't need to read any book. Look at the things happening on the internet now and just turn it the other way around to fit the laws, the tax that you are learning. Are we okay?
Yeah.
Yeah, that's all. So have
Prof,
we with the yes.
What are romance
my question is that, for instance, like the tax audit that we wrote, some of the questions are so practical, and if you use experience to write them, do you really go by strictly by marking scheme or?
No. For tax is open. Tax is
Okay.
open. But something like international tax, where is that application? If you don't know the principle, you can't apply. That's why I tell you, international tax is principle based. Okay, unlike tax audit, to be the wide range, but still it should be around. Do you get it? What you learned. But international tax is purely principle based. Into principle, now final the wide range tra. Yeah, mau. Unless it's something that is happening. Do you understand what I mean?
Yeah, we got you.
All right. So that's what I'm saying. You get.
Yeah.
Boss name is second.
Umpeo,
Papa.
ube pass. So umpeo, ube pass.
It's a must.
Okay. So I want us to please, did you get the PE areas? Let's take some questions on the PE before I go into the pillar 1, pillar 2. And then I think Let me just get some material that I have on pillar 1, pillar 2, if I have it here. But let me explain it simply. You see all this problem we saw in the digital economy, right? You see all these problems we saw in the digital economy.
Yes,
What are the
Prof.
problems we saw in the digital economy? Now, they came up with proposals to try and then what? Solve them. And then we have what we call the pillar 1, and then we have what we call what? The pillar 2. Now, let me first explain the pillar 1. The pillar 1 is saying that because it's difficult to really tell which country we make our revenues from, why don't we rather tax the country we have more of our customers in there? Do you understand? Does the rule make sense?
Yes, Prof.
So we will rather what? Go to the country where we have more of our customers from, and then we'll try and then what? Then we'll try and rather tax there. Do you understand? Or tax income from that side. I hope it makes sense.
Prof, please come again.
T. You know, it is difficult to actually see where we are getting our income from, or?
Yes, Prof.
So we rather look at the countries. This thing, it started with the fund companies. Do you know what we call the fund companies?
Yes, Prof.
Who are the fund companies?
Facebook, Amazon, Netflix, Google, also.
And Google. Yes. So these ones are the companies, are you getting it? The fund companies, or the companies that these multinationals, right? That actually what do we call it? Worry this system, right? And because these companies usually worry this system, that is why they brought these things. Because Facebook is everywhere, right? You can't really tell which country Facebook actually exists. Do you understand? Do you understand? You can't really tell which country Facebook actually what exists, because Facebook is everywhere. Every Tom, Dick, and Harry has something connected with Facebook. Or so because of that, they said, you know something, why not do something like this? Rather get a country where Facebook has majority of its what?
Users.
Its users, and rather let's tax them based on the percentage in that particular country. Does it make sense that way? You see, now it makes a bit of sense, right?
So that's the amount A.
Yes, Prof.
Yes, that's the amount A.
Okay.
Do you get the idea?
Yes, Prof.
Good. Then when it comes to the other side of it, which is the what do we even call it? Bro, a brain team, a drink cranes.
Amount B.
Amount B.
Not amount B. I'm talking about pillar 2. I'm just giving you the general idea. I'm now
Pillar
coming
2.
to go
Oh,
deeper.
okay.
Now, pillar 2 focuses more on anti-avoidance. Do you get what I mean when I say anti-avoidance? You know, most people will try to bypass the tax
Yes,
authorities,
Prof.
right? Most people will try to mostly bypass the tax authority. So what will happen is that here we are concerned about anti-avoidance provisions to stop people from taking advantage of these anti-avoidance rules that we know about. Do you get the idea? Do you get the idea?
Yes, sir.
Yes, Prof.
Come in. I just want us to look at these things in detail. Nice man. My PC is slowing down. I'm coming right now. Oh, the PC has been up for a long time, so I'm building an app on the background, so it's slowing down my memory. Sorry, I can't close down the app because my database structuring is what is worrying me. It's consuming a lot of CPU. Oh, why? I'm coming right now, Let me try and disable my QLI. Let me disable this. Vara, move it into SQLite. Move it into SQLite and then send all to my GitHub repo. Yes, STBP. Deploy only the finished parts to Vercel. All right. Send me the code to approve before you finish up, right? Okay. That's my AI called Vara to finish some of the code for me.
Nice name.
Okay.
Someone go and name their child.
Eh. Okay.
Yeah. All right. So should we look at international tax planning overall, or just look at the, what do we call it? The pillar 1, pillar 2.
You said finish the pillar 1, pillar
Everything.
2.
Everything so.
Okay, let me see. All right. So let's see. Okay, so I think I might have something here. Okay. So yeah, so I think I have something here. All right, so good. Introduction to international tax planning. Okay, so when we talk about international tax planning, it refers to the arrangement of cross-border business activities and investments in the manner that achieves tax efficiency while also complying with tax laws of different jurisdictions. So why do we do international tax planning? The main objective is to minimize unnecessary tax costs, avoid double taxation, and maximize our after-tax returns. Also to ensure compliance with international tax rules. Okay. So for instance, if a multinational company operates in what? In Ghana and another country, it may structure its financing arrangement. Usually your examiner can ask you, this has come in international tax before, right? Financing arrangement, whether you should finance by equity or you should finance by debt. Which one will you go to? Which one will you go for? Equity or debt?
Debt.
Debt. Why? Because interest is an
Yes.
allowable deduction,
That's
right? Thank you. Interest as a tax shield. So they can ask you for other alternatives of financing. So other alternatives of financing, you can go with leasing, finance lease. You can go with sale or lease back. Are you getting it? You can go with hybrid instruments. That's what? Something like compound instruments or convertible loan stock. Okay. If you are going deeper, you can go with mezzanine finance, which is used to finance management buyouts and venture capital financing and the rest. Do you understand? So financing arrangement, they've been asking in international tax, but it's been a while. Maybe this time, who knows? They can ask you something around that. Somebody's hand is up, but my captions is not making me see. Ray, my hand is up.
Prof, I thought we were doing a pillar 2.
Then we will come there. It's part of this. That's the thing that brought this. So we'll talk about it.
Okay.
I just want to talk about it once because I don't want it to be here and there. I get it. So when we talk about international tax planning and domestic tax planning, you need to understand the difference. International tax planning involves multiple countries, while domestic tax planning involves just one country. One uses domestic tax rules, one uses various domestic laws and the treaties. Are you getting it? So they can ask you the difference between the two. So the advantages of international tax planning, I don't really need it. What I'm concerned about are the principles that people know, right? You should understand the difference between tax evasion and tax avoidance. I hope you know the difference. Tax evasion, you are using illegal means like fraud, concealment, or misrepresentation to escape taxes. But tax avoidance, you are exploiting loopholes in the law. Are you getting it? No, be so. No, be so.
So, it is so.
Yes. But then we have something called aggressive tax avoidance or aggressive tax planning, where you use unapproved methods. Okay, you're using things that the law may not really know about, right? Just to reduce your tax liability, like artificial structures or things that are not real, or you're abusing treaties like treaty shopping or treaty abuse and profit
Prof.
shift. Yes, please.
Technically, why do we say using loopholes? To mean that weakness or something, if the tax law is propounded to address a certain area
Let
and
me
where
explain. Let me just explain what we mean by a loophole in tax. Loophole in tax is a transaction or it's a provision that the law has made, right? With the intention that it will help, but people take advantage of it. For instance, look at this. When you go to Section 10 It tells you that interest is an allowable deduction so far as the debt obligation was acquired. Are you getting it? To acquire an asset in your business or to finance your working capital, right? Good. Now, they are telling me that this is what the law says. So far as I borrow a loan and then I use it to buy an asset, or I use it to finance my business, right? Then any interest on that loan should be deducted from my can be deducted from my profit. The law didn't tell me where to get it from. It didn't tell me how much to get it from, how much to get. It didn't tell me what percentage should be applied. These are all loopholes. It means that I can borrow a loan from my mother, and me and my mother can plan that, give me a loan of 5 billion, and then put 30% interest on it. If my profit 5 billion by 30%, that will eat up all my profit. No be so. This is a typical loophole. Do you get it? If you are telling me where a resident company acquires 25% of another resident company, if he pays dividend, is exempt, it's a loophole. I can acquire a resident company who in turn acquire another resident company, so that when dividends are paid, I will be the beneficial owner to receive it. It's a loophole. Do you get it? There are so many loopholes in the law. So people take advantage of these loopholes by creating artificial transactions. Do you get it?
I get it, but I feel that no law will be exhaustive to cover everything. So
that is
for
it.
me personally, the use of loophole as if it makes me areas that, well, I don't know how to even convey my thoughts, but I understand where you are coming from. Yes.
So because the law knows that it can't cover all loopholes, it brings something we call anti-avoidance provisions. And these anti-avoidance provisions are provisions which are specific to the known loopholes and the ones that are general. So if you do any transaction in Ghana, the commissioner does not understand, he will ask you questions, and where he does not understand, he will disallow. Then you will now come and file objection and let us understand. Do you understand?
Okay.
So if you are trying to exploit a loophole, it will all come out. So there are so many provisions, but because I'm not teaching you tax planning, I'm just teaching you international tax, I can't go further, right? But there are so many things, because you must understand things like substance over form, you must understand the doctrine of label, you must understand sham transaction doctrine, you must understand business purpose doctrine, you must understand step transaction doctrine as well. Okay, so there are so many judicial principles we use in tax planning, and the law courts have applied it over the years. All right, so these are some of the things.
Thank you, Prof.
And that's why I don't like tax. I don't like tax at all. All right, so me, I like accounting more than tax. So I don't like tax like that. All right, so treaty shopping. We talked about it briefly. Now, you see the things that I'm teaching you, see that I say, do you know why? Now, they don't expect you to have one topic as one topic. They want you to have central knowledge. And you will see it tomorrow by what I'm talking about. Wake Akrawaha, Obi Baakon, he's an artist and sportsman. He's an artist in one way. He also is a researcher in another place. Do you get the idea? Somebody who sings, he also has a theater somewhere. Do you get it? Meaning they are mixing what? That this person who sings also has maybe a theater art somewhere. You see, they are mixing what? Teachers and researchers with artists and sports person in one scenario. Do you get the idea? But let's take our time and understand this. So treaty shopping occurs where a person who is not entitled to treaty benefit structures transactions through another country solely to access favorable treaty provisions. We saw that, right? So mostly that country will create a shell company, or what we call the special purpose vehicle. You remember we said it, like the Canada company who acquired what? The Mauritius company to acquire the company in Ghana. Do you remember? This is how treaty shopping works. I get it. So why treaty shopping? They may seek what? Reduce withholding taxes or lower capital gain taxation, better treaty protection, or to avoid source taxation. What are some of the problems caused by treaty shopping? So countries will lose revenue because what? The treaty benefits are granted to unintended persons, the tax is shifted artificially, and economic activity does not match the legal structure. What are measures that are what? Given against treaty shopping per the DTAs? One, we have what we call limitation of benefit clauses. So limitation of benefit, please note these things very well. Oh. Don't tell me you have forgotten tomorrow morning. Limitation of benefit rule means these are rules that restrict treaty benefits to persons with sufficient connection to the treaty country. So some DTAs have specific limitation of benefit rule. So it limits you to what? The treaty country, let's say Ghana. So, for instance, a company must have active business or ownership requirements or economic substance as a rule before it can enjoy some provisions in the DTA. Then we have something we call the principal purpose test in the DTAs. It was introduced under Article 6. What's the rule? The rule says that a treaty benefit may be denied where one of the principal purposes of an arrangement was to obtain that benefit. This is what I was saying, that is the business purpose rule. So if the tax authorities examine this and see that no, the thing you are doing wasn't because you want to do business, but you did it because you want to enjoy a benefit in a particular treaty, they will deny you. I cannot deny you, Odo. Okay, they will deny you. You understand? You get the idea? Yes. So let's see that. Let's say that your company creates mailbox company only to reduce withholding tax. The benefit will be denied. When we say mailbox company, are you getting it? You have created a shell corporation or a conduit entity just because you want to reduce withholding tax, like the Canada thing we saw. If the authority sees this, he can trigger, if it's domestic law, we can trigger Section 99. Are you getting it? The tax avoidance arrangement, we can trigger Section 98.5 treaty shopping, or we can of the Revenue Administration Act, or we can trigger Section 34. Are you getting it? Which cover general anti-avoidance rules, or we can trigger Section 27, which covers indirect tax, indirect payments. Okay, we'll come and look at all that. Those things are very important. Do you get it? So another way we also deal with treaty shopping and those things is also by what? Beneficial ownership requirement. So treaty benefits may require what? The recipient to be the true beneficial owner before you can enjoy the treaty benefits. Do you understand? So, me in Trawa no. Me in Trawa no. Look at the B part of the question. What did they say? The B part of the GASGA question we're looking at. What does it say? The B. Read the B for me. What does it say? Oh, please, quickly. We have a lot to do. The way people are relaxed.
Explain any 4 anti-avoidance provisions that the Ghana Revenue Authority may use.
They used to counteract the arrangement between the companies. No, be so. 2 from the DTA and 2 from the Act. 2 from the DTA. The DTA, what are some of the rules we have looked at for solving treaty shopping? 1, limitation of benefit clause. 2, principal purpose test. 3, beneficial ownership rules. See, the things are the same things we are learning. And then from the Income Tax Act, we have arm's length provision, we have general anti-avoidance rule, thing capitalization, indirect payments, changes in accounting, plenty. You get it? But then now this is what I want you to be interested in: the beneficial owner requirement, the principal purpose test, and then the what? And then what else? Limitation of benefit. Please don't forget to LOB, principal purpose test, PPT, and then BU. LOB to PPT to BU. Are we okay? So what is LOB? Limitation of benefit. PPT, principal purpose test. Then what? BO rules. That's what? Beneficial ownership. Good. So we have holding company structures, which companies also use. So when we say a holding company, that's a company established mainly to own shares in other companies, like a parent companies. So why do people use holding companies? for investment management, dividend planning, right? Risk management, financing efficiency. So what are some of the tax planning considerations? So countries may provide what things like dividend exemptions, capital gains exemptions, or participating exemptions for holding companies. That is why people usually what go and own a lot of subsidiaries in different countries. So the way you structure your activity, okay, there are so many structures you can do that will mask. In America, we use something we call inversions, right? Ghana, there's nothing like that. So when you study some laws, you can apply something like that and it will mask the overall parent company. So look at this parent company, right? He has a Ghana sub, another foreign sub. Do you get it? And then maybe one of them will use a tax structure and another of them will use a private partnership structure. Okay. And there are so many rules. I get it. Then people can also adopt financing structure. That's where they use financing arrangements for tax planning. Okay. So a group company may provide loans to another group company and the interest may be deductible in the borrowing country. You remember transfer pricing, we saw financing arrangements. You remember? And this financing arrangements too can be used to what? Save taxes because interest is an allowable what? So company A lends money to company B. Company B deducts the interest expense. Company A receives interest income. But here what happens is that company A will be at a place where the tax is very low. Do you get it? So that even if you receive the income, it will be lower. Do you get the idea? So this is what people do. Then we have something called hybrid mismatch arrangements. Maybe we'll talk about it later. Right? The risk is that there will be excessive debt, artificial interest payment, and base erosion. Then think up. I don't have to even talk about think up. Let me just move. Then when we talk about base erosion, what does it mean? This is where taxable profits are reduced or shifted away from countries where economic activities actually occur. That's what we call base erosion. So why do we do that? Because of what? Excessive debt deductions or royalty payments or management fees or transfer pricing manipulation. When we say profit shifting, we mean profits are transferred from high tax countries to low tax countries so that they are taxed at a lower rate. So when we say base erosion and profit shifting, we mean tax planning strategies used by multinational enterprises to exploit gaps in international tax rules and shift profits to locations where little or no tax is paid. And this is where we must use this to understand what do we call it? Tax havens and professional tax regimes. Now, the OECD or G20 BEPS project is what brought this, and there are 15 action plans. Right now, why do we have BEPS action projects? Is to ensure what profits are taxed where economic activity actually occurs, to prevent artificial profit shifting and improve transparency. So what are the various areas we had? So we have the action one, which talks about addressing the tax challenges of the digital economy, and that's where your examiner really focuses, right? Then we have what we call neutralizing hybrid what mismatch arrangement, action two. Now, let me explain hybrid mismatch arrangement. Okay, so this is usually a double arrangement. So look, I have given you income, right? Or I have given you loan. Okay, that loan at your end is an allowable deduction, right? At my end is an income, but I'm paying a lower tax. So what happens is that I end up what saving twice. Another issue is that you see, I give you there are some countries, if you give interest to somebody, if you give loan to somebody, the interest income you receive is exempt from tax. Okay, but then if that interest also comes to me, I have to pay you interest. It will also be deductible in my law, right? True or false?
True.
So have I not gotten a double benefit?
You have.
Yes. So this is what we call a hybrid mismatch arrangement. So some countries, they don't accept interest. So if you bring it, they'll treat it as dividend, which will be lower. So it becomes a hybrid mismatch arrangement. So there are so many things people use. We have double dip leases. International tax planning itself is a course on its own, beyond the scope of CIT, right? Where you get to actually understand it. So when we say hybrid mismatch arrangement, we mean that two countries treat the same transaction or financial instrument differently for tax purposes, right? That can create an unintended tax advantage. So it's simply a tax classification mismatch, right? So let's say that in Ghana, the payment is an expense, but in UK, the payment is not taxable at all. So at the end of the day, you get an expense which reduces your tax. And in the UK, it is what? Also exempt. So you get a double tax benefit. That's what we call hybrid mismatch arrangement. Do you get the idea? Why are they called hybrid? Because hybrid is something that is treated separately or differently in two separate countries. Do you get it? I can't go into the types of hybrid mismatch. I'm not sure your examiner will go that far. If he goes that far, then he's wicked. No, even at high levels, we don't even go that deep, but at least you understand what it means, right? So we also strengthen controlled foreign corporation rules. That's the CFC rules. Don't worry about that. Also, we limit what excessive interest deductions. We have harmful tax practices, preventing treaty abuse, preventing artificial avoidance of a PE status, right? Transfer pricing, alignment with value creation is under Article 8, Actions 8 to 10. We have country by country report section 13, then improving dispute resolution or improving what map does it, right? Now, mostly when they tell you to discuss international tax planning strategies, I get it. You must always talk about international planning, tax planning, the objectives, tax avoidance and evasion, treaty shopping, holding companies, and the BEPS and the things you can talk about to get the marks, right? So a question can just come and ask you to discuss international tax planning strategies and associated risks for 20 marks, just like that.
Hey.
Yes. So all the things we talked about, you put all together, whatever you remember. Hmm? So everything I'm saying, I'm not just saying it for hearsay. Okay. So always remember trap BIPs, right? Trap BIPs, treaty shopping, residence planning, avoidance risks, profit shifting, then BIPs, you remember base erosion, excessive debt, permanent establishment planning, and substance requirements, because you have to check the substance over form. Okay, so BIPs, we've talked about BIPs already. I wouldn't worry myself that much. What I'm concerned about is yeah. The two pillar solution. All right. So pillar one has to do with what? Reallocation of taxing rights. Okay. So why pillar one is to give market jurisdiction greater taxing rights over profits of large multinational enterprises. If Facebook's customers, right, majority of them are here in Ghana, and then Facebook just takes money from them through ads and uses their platform. Are you getting it? And they buy things from Facebook Marketplace. And Facebook takes all the money. Is it being fair to Ghana?
No.
No. So why did we bring pillar one? Is to give market jurisdictions greater taxing rights over profit of these large multinational enterprises. Then pillar two is where we have a global minimum tax to ensure multinational enterprises pay at least a minimum level of tax regardless of where their profits are located. You first get the main idea behind it. So pillar one, we are allocating your taxing rights to countries where at least you have some activity there. Let's give them something, because they created a room for you to get their members. Do you get it? But pillar two is to avoid what? Tax avoidance. So we have a global minimum tax. Please, do you get the whole idea behind it?
Yeah.
Do you get the whole idea? Is the idea first, then when I bring the principle, it makes sense. Did it make sense?
Yes, ma'am.
Good. So pillar one. Why pillar one? So pillar one changes the traditional allocation of taxing right. Previously, taxing rights mainly followed physical presence and PE. But under pillar one, taxing rights may now what arise based on your customer location and what your market jurisdiction. Does it make sense? Are you following now? Is it making sense? You
Yeah.
know, before we can only tax you when you have physical presence in a particular country or where you have a PE there. Meboa. But now we don't do that. Based on pillar one, we are saying that let's look at where your majority of your customers are and what market jurisdictions you are trading in. For instance, if a technology company based in country A earns revenue from Ghana customers, under the traditional rules, Ghana may have limited taxing rights because we don't know where it is located, right? Online. But now Ghana may receive taxing right because it is the market where the customers are located. Make sense?
Yeah.
Good. So companies covered under pillar one. Okay, so pillar one only mainly targets what? Large multinational companies. Okay, that meet revenue threshold of more than 20 billion global revenue euro. So if pillar one, I get in it, will apply when you make at least 20 billion global revenue and you make profits, I get it, before tax above 10% of your revenue. That is when we start applying pillar one. Make sense? Don't forget this, 20 billion euro. And then what? More than 10%.
Profit.
Yes, of your profit before tax, right? So the threshold
Prof,
is use over time.
How easy? Well, can I ask a question?
Please
With
ask.
respect to the pillar one,
Yes.
how easy is it for you to locate those customers? If, for example, it's an
But they're on your
online business.
platform. Right now, if I go to Facebook, I can just demand their database. I'll see all customers, where they are from. So it's even easier.
Yeah. And when you are registering, you enter your country too.
You don't even need to enter your country. Your IP address tells exactly where you are. That's how Facebook actually tracks
Okay.
you. Sometimes you've seen that sometimes you are there, you click one ad, no, then the ad is following you everywhere. Have you noticed that? What has it happened to
Yeah.
you? Yes. So we use cookies, we use sessions, we use it to track you. So all your information now, if these companies decide to sell it, it's a lot of money. You are being watched every day. And this
I'm
thing,
actually asking how the taxing authorities are able to
that's why I said they will
quantify those
demand the
ones.
databases. That's what they use to know
Okay.
which countries. I get it. It's through exchange of information. If Facebook's headquarters
Okay.
pays tax in the UK, for instance, I getting it for their UK activities, Ghana has a DTA with UK, can demand information from the UK authorities on request. Meboa. So they can get all the data from Facebook and then apply these principles.
Okay. Thank
Good.
you.
So pillar one, what are we looking at? 20 billion what? Euros. Or profit before tax above 10% of revenue. Don't forget this. Then we are saying that there are some components of pillar one: amount A, amount B, and tax certainty. What is it? Amount A, amount B, and tax certainty. So what is amount A? So amount A refers to a portion of the residual profits, right? And cashier of the large multinational entities allocated to market jurisdictions where customers or users are located. This is what I was saying before, that we look at where majority of your users are located, right? This is to allow market countries to what? Tax part of profit even without what? Physical presence. Are you getting it? So amount A, no, it involves what? Determining your global revenue, determining how profitable you are, identify any profits which are residual, then you allocate a portion of the residual profit to the market jurisdictions, right? So if I make 50 billion and my profit margin is 20%, I get it. I want a routine return of 10%. If this is my total profit and routine contribution, just like we did in transfer pricing. So all these things are linked to transfer pricing. Oh. Just like we don't want you to go that deep. Do you get it? So if my profit is 20% and I always need a routine return, that's my general return, the rest will be the residual profit, which is the 10% left. Right? So a percentage of this residual profit will be allocated to the market countries where majority of your customers are. This is how amount A works. So why amount A? Are you getting it? It is to address digital businesses and consumer-facing businesses and also market country concerns, right? Most businesses that are affected will be tech companies, online marketplaces, and social media platforms. Are we getting?
Hey,
So let's go and look at amount B.
do you
Now,
remember the
hey, please, somebody's
there
background
is
noise.
this split method? Is it income split or what is it? I've taken note something that I wanted to attend to before tomorrow. There's something about split. Is it income split?
Income splitting. What do you want to know about income splitting?
It's this question that will have a number of.
Are you speaking to someone, Mike? Or you are speaking to me? Are you speaking to someone? Oh, he just cut my conversation. Amount B provides a simplified and standardized approach for pricing, setting baseline marketing and distribution activities. Okay, so this one, amount B is transfer pricing dispute. It settles transfer pricing dispute. Are you getting it? So let's say that if a multinational sells products through a local distributor, the distributor earns a routine return, right? Amount B provides guidance on how to determine that return. Okay, so that routine return that you do from selling the products or services, now amount B now provides guidance on how that return will be determined, so that dispute will be resolved. Are you getting it? And to provide certainty or help the developing countries to transfer transfer pricing rules or administer them well. Then tax certainty, are you getting it? Is dispute resolution mechanisms through what? Mandatory binding dispute resolution or MAP, mutual agreement procedures. right? The Pillar 2 talks about a global minimum tax. It ensures that the large multinational groups pay a minimum effective tax rate regardless of where their profits are located. So at least Pillar 2, you should pay a minimum of at least 15% of your global taxes, right? Your profit. So if a multinational earns profit in a country where it tax profit at 5%, you have to top up. You get the whole idea? Under Pillar 2, an additional tax may be imposed to bring the effective tax rate back to 15%. Do you see how Pillar 2 works? So that one, we want a global minimum tax that companies should not pay below 15% of their global. So if you're in a country and you are paying tax at 5%, per Pillar 2, you have to add the extra 10%, or the parent company has to top it up so that you pay 15. Makes sense? Do you get it? But for Pillar 2, for you to be covered under Pillar 2, you should make 750 million euros. Pillar 1, what was it? 20 billion euros. But Pillar 2, how much?
750 million.
Euros.
So which is bigger? Pillar 1 or Pillar 2?
Pillar, I don't remember.
Pillar 1.
Euros.
Pillar 1 is billion. This is million.
Million.
So let me ask a quick question. How much must your transactions be worth to apply a country by country report?
2.9 billion Ghana cedis.
Billion Ghana cedis.
Billion Ghana cedi.
Is it 2.7 or 2.9?
2.9.
2.9, boss, which you want.
Okay.
Okay, so Pillar 2, there are some rules we need to understand with Pillar 2. What's the minimum tax? What's the minimum tax rate for Pillar 2?
15%.
15%. In a case where you pay lower than the 15%, your parent company has to top up to bring you back to the 15. Do you understand? Good.
Yeah.
So there are some rules, just like we looked at. Pillar 1, what are the rules under Pillar 1? Amount A, amount B, and what? Tax certainty. Pillar 2, we have rules like income inclusion rule. Income inclusion rule means that the parent company pays the top-up tax on a low tax income of subsidiaries. So if the parent company is in country A, the subsidiary is in country B, and country B pays tax rate of 5%, and the minimum rate is 15, the parent will pay top-up tax of what? 10%. And that's what we call what? The income inclusion rule. Are you writing these things down? Does it make sense? I've broken it down to class 5 level for you. I hope it makes sense.
Yes, Prof.
Income, or am I lying? Income inclusion rule, meaning we include the income when it has not been included. It makes a way where there's no way. In the way, no 5%, will make a way by adding extra 10 to it. So income inclusion rule. Do you understand? But before we can apply all this, you must have made revenue of about 750 million euros. Or?
Yeah.
Okay. Then we have under taxed profit rule. Now, this is a backstop rule that applies where low tax income is not taxed under the income inclusion rule. So, for instance, you see, there are some countries that may try to manipulate incomes by looking for what? By looking for loopholes. So, if we have seen that you, in the particular country that you went, I get it, the income that you were having itself was not taxable, or you were applying some sort of tax avoidance provision, are you getting it? We may deny you that low tax rule. So this means that other countries may deny deductions or impose additional tax because you are trying to look for loopholes. So under tax profits, we will not allow you deduction. We will deny you. Do you get it? So this is more like the principal purpose test. If we see that income, no, you try to maneuver your way around it to sort of save taxes, we will deny you because it doesn't meet the principal purpose test. That's what we call the under tax profit rule. So let's say that a subsidiary pays insufficient tax, then no parent company applies what? The income inclusion rule. And another jurisdiction, are you getting it? We apply all those rules which will impose additional tax. Do you understand? Do you get what I mean?
Yes, sir.
So when we say that, okay, if your profits are under tax, no company will top up for you because you yourself, your profits are under tax in that jurisdiction. So if you pay low tax in one country, then the parent will not top up. The other countries will also what? Apply the under tax profit rule, meaning all the other rules, right? Which will make you pay excess tax or which will deny you deductions that you were taking advantage of. Are we okay? Then we have what? The qualified domestic minimum top-up tax, the QDMTT. These things, they don't ask you that deep, though. I don't even know why I'm going that further. Right? So a domestic minimum tax that allows a country to collect top-up tax from entities operating within its territory. So if you are operating within a particular company's territory, country's territory, you can collect an additional top-up tax from you because you're operating in Ghana. So if my sister company is in Ghana, GRA can collect what? Domestic top-up tax from them. Is that clear?
Yeah.
Is that clear? So pillar one, what did we learn about pillar one? One, market jurisdiction. No be so. What is the requirement? 20 billion.
20 billion.
20 billion euros. So the whole thing is that when you look at the two pillars, pillar one talks about where to tax, and it's more about the market jurisdictions, right? And what's the requirement? 10% residual profit. No be so. At least 10% residual profit and what? 20 billion. And what are the considerations? Market jurisdiction, amount A, amount B. Okay, pillar 2 talks about how much tax. So we have the minimum 15%, 750 million, right? The income inclusion rule and the tax profit rule, and then what? The minimum top-up tax rule, right? The qualified domestic minimum top-up tax rule. So this is your pillar 1 and pillar 2, yeah.
Prof, please, so what question would require you to provide the pillar 1 and pillar 2?
Oh, they will ask you directly. That explain them.
Is it not above our level?
They will ask you to explain them.
pillar 1 and pillar 2.
I said they will ask you to explain them.
Okay.
So please, can you explain it once more again so that we can get
So
it?
it's not an application question.
No.
It wouldn't be okay.
It will never be application to be
Okay.
clear.
So take it one more time again, just a summary, an overview, just a little overview.
Is it not right now that I summarize this?
Yeah,
I
missed
won't
the
do it
point.
again. I won't do it again.
Oh,
I have done this. I have summarized it. I said
so one more time.
pillar one, we allocate to where your customers are located, market jurisdictions. Requirement is for big companies like the FAANG companies, Facebook, Google, Amazon, Netflix, right? They should have revenue of at least 20 billion euros, or their profit before tax, right? The residual profit should at least be 10% before they can apply this rule. So we have amount A, we have amount B, and we have tax certainty there. Then we come to pillar 2, which is where how much the tax should be. So that one too, we said that what you must make what global tax of at least 15%. If you are below, you will top up. So we have the inclusion rule, where if the subsidiary is making lower than that, we will top up to get there. We have the tax profit rule, meaning that if you are paying lesser taxes, the parent will deny you. They will deny you deductions as well from other countries. And then we have the qualified domestic top-up tax rule, which says that even if the parent is not doing that, Ghana in itself or the country you operate in, the tax authorities can make you pay top-up tax. So that's pillar 1 and pillar 2.
All right, so thank you.
All right. Okay, so let's go to PE in the digital economy. Now we've seen the weaknesses of the digital economy. Now let's go PE in the digital economy, right? Now, when it comes to PE in the digital economy, there are 3 things I need you to understand: computer server, independent service provider, and website. Now, the whole thing is that because of the digital economy problem, it's difficult to determine where there's a PE status. Do you remember? Yes, so because of that, we rely on the computer server. and even the computer server, where the server is located. Why? Because you know, a computer server is a physical machine. Meboa. Some people thought server was a software. No, server is a machine. It has a physical location. So where the server is located can create a PE. But however, if the server is just performing activities on its own, it doesn't necessarily create a PE unless there's some sort of human intervention, or there's there's the core business of the enterprise is being carried out through the server. So if most of the server activities are mostly automated and it doesn't really relate to your business like that, it doesn't create a PE. But if, let's say, I am the one typing and the server processes it, then the server sends me, I receive order, I go and pick up the order, I send it here, I send it there, I take up this, they are processed through the server, then it looks more like the business of the enterprise is being carried on. True or false?
True.
So just where the location of the server is not enough to create a PE. Something must follow the business of the enterprise and some sort of person doing something. Makes sense. But sometimes, even though there may not necessarily be human intervention like that, when the whole business is only done by the server, but it's the actual business of the entity, and it's not preparatory auxiliary in nature, it creates a PE. You get? Good. Now, what about an independent internet service provider like MTN? He provides internet. Can MTN be your PE? No, he can't. Why? Because it's the data that MTN gives you. Is he your PE? No, he's working in the ordinary course of the business. So an internet service provider can never be your PE. What about a website? A website can never be a PE because a website is only used to relay information. True or false? So a website can also create a PE. You say this, you get 10 marks. So remember, computer server, independent internet service provider, and website. Which of them creates a PE?
Computer server.
Computer server. Okay, and then we are looking at the core business of the entity. It shouldn't be preparatory or auxiliary. Okay, so we are saying that this question requires candidates to analyze how current taxing rules is used to determine the taxable presence of a non-resident person as impacted by the use of the internet, such as the website, the computer server, and the internet service provider. Candidates are to explain the impact that these elements are as indicated in the question impact on PE rules. In the instance case, regarding the issue, the following are considered. Article 5.1 defines the PE to mean fixed place through which business is carried out wholly or partly. So computer server, the use of computer equipment or a server, right? So a computer or equipment can be considered to have a fixed place through which the business is carried on. And this falls within the meaning provided in Article 5.1. Do you remember? Now, where the server is located can give distinctive clearance on the availability of a PE. I told you. Now, the location of the computer equipment or automated equipment is very relevant in determining the taxability of the business income derived from the online transaction. The OECD position on this is explained in paragraph 42.2 of the commentary of Article 5. The server is a piece of equipment that has a physical location. You remember I told you that that location may constitute a fixed place of the business of the enterprise that operates that server. For instance, when an enterprise conducts a business through a website hosted on server located in South Africa, the PE may be said to be located in that country. Do you get the idea? Do you remember?
Yes, Prof.
Yes.
So the use of a website. The website is software or data located on a server. It is available on the World Wide Web that the customer may be able to access. So a website does not constitute a fixed place of carrying on business. And it does not have what? A location that can be said to have a facility, which is premise, machinery, or equipment. At its best, it's auxiliary and preparatory to the core business. In fact, the OECD position on this is that the internet website, which is a combination of software and electronic data, does not in itself constitute tangible property. It therefore does not have a location that may constitute a PE. Do you understand? What about ISP, Internet Service Provider? Now, an ISP is a company that provides internet connection for fees. The main function that the ISP undertakes is hosting of website of another enterprise. So the ISP is said to carry on business in its own course of business as an independent person. So according to Article 5.6, where a person other than a dependent person carries on business in its own name or business activity, the person is not deemed to be a PE of the non-resident, right? So according to the commentary to the UN on OECD, paragraph 32 of Article 5, a person is considered to be deemed as a PE of a foreign partner where he has authority to conclude contract on behalf or in the name of the enterprise. ISP does not conclude contract in the name of the enterprise, nor do their activities contribute significantly towards the conclusion of the contract. As such, an ISP cannot be considered as a PE. Rather, it is an independent person carrying on business in its ordinary course of business. Is that not what we said? So anytime PE from the digital economy should pop up, it will come in three ways. It can come with the tax challenges of the digital economy, come with pillar 1, pillar 2, or come like this. Okay? If you need proof, look at this question. It's been a long time since I saw Millicent, but she will always be my number one chick. This kind of question, eh? All right. So, Accra Web Limited was registered in Ghana on 3rd January 2011 and commenced business activities on 14 January 2011. The company sells its merchandise via the internet. So immediately you see internet, you remember what? That one of the options they can ask you is what? The tax challenges of the digital economy. Remember what? So it maintains a website which domain name is registered in the USA and rents a server operated by an independent service provider in Nigeria. So you see, we are seeing the terms. Are we not? One, we saw server, we saw domain name, we saw internet. Server, where was it? Nigeria. But just the server alone being in Nigeria does not mean that, so far as, yes, that's the location of the server. It does not necessarily mean that, what? We have a P in Nigeria. Let's see. It says Accra Web Limited has an office in Accra, which is manned by general manager and 4 supporting staff. Customers all over the world place orders via the internet to the server in Nigeria. The server processes the orders, directs customers how to make payment, and issues instructions to the staff in Accra to supply the product from a warehouse in Accra. The server also monitors the company's stock levels and places orders to suppliers in Taiwan, South Africa, Japan, and China, if necessary. The server then instructs the staff in the Accra office to take delivery of the product. When they arrive at Ghana port, they clear the product from the port and warehouse them. The server instructs bankers to effect payments to the suppliers. All customer concerns are handled by the staff in the Accra office. The suppliers meet the general manager in Accra to negotiate and finalize business deals. The general manager makes financing and financial strategies. Marketing and financial strategies are formulated by the general manager, right? In Accra, he inputs the trading and payment parameters into the server. So he gives the server instructions where the server now processes everything that it is doing automatically. So the general manager approached you, an expert in international tax, to advise him on the tax implication of the activities of Accra Web and staff remuneration in all countries in which the company has business dealings. So my question is, where the server is located, is there a PE or the PE is in Ghana? Look at it carefully. Was the server doing everything automatically or some human somewhere was in the loop controlling the server?
Human intervention.
And who was that? The general manager.
The manager in Accra Web.
Yeah, so it tells you that more of the activities of Accra Web are actually going on in Ghana. And even in Ghana, they had an office. An office is one of the fixed place PE. So in conclusion, I think Accra Web has a what? A PE in Ghana. Nigeria, no, the server is located there, but it didn't create a PE because there was a human in the loop. Two, the domain in the USA is just a registered domain, has no activity. It doesn't have any physical presence. That's just the domain name. It doesn't create any way. You get the idea? That's all. PE go in, it's gone. It's gone. It's gone. It's gone. It's gone. Everything in PE has been covered nicely. All right. If you have any question, I did for you. If not, we go
Prof,
to
so this particular question. Sorry, I didn't hear the conclusion of it.
Then they have a PE in Ghana. You saw what was happening. Where were most of the activities taking place? Was it Nigeria? It was Ghana. In the question, where
It was
was
in Ghana.
active? It was in Ghana, so they have a PE in Ghana. Because even the server, the things the server was doing was somebody who keyed it in, which was an MD, the general manager. They said it. That he gives all the instructions the server carries out in Ghana. Assuming no instructions was given, and the server did everything without that instruction from the general manager, then we could say that. And some of the activities or the other staff in Nigeria who were doing some things, it tells us that more of the thing was leaning towards Nigeria. So Nigeria would have been where the PE is located. But here lies the case. Everything was directing towards Ghana, and they even had an office in Ghana where they go through, they use the server, even though the server is in Nigeria. So it tells you Ghana becomes a PE. Anyway, that's just by the way.
Okay.
All right.
Thank you.
You're welcome. So let's look at how to deal with passive income. That's why I taught you those rules before we look at passive income. Now, you see these rules you are seeing here. Can you see that? I told you everything I do, I use frameworks. Can you see that? You see the rules in front of you. Anytime passive income comes, whether interest, dividend, Sarah, Monica, gift in a diner, right? So we are saying that when it comes to passive income questions, all right, you have to follow this principle. Are we okay? And what is the framework? The framework is that you must first, please, whose background is that? Whose background is that? It's disturbing. Or... Yes, so we are saying that first, you must identify whether the question relates to passive income, right? Interest, dividend, royalty. And you need to explain the principle of who has the taxing rights under the DT. I say you need to understand what the principle of what? Who has the taxing rights under the DT? And for taxing rights on passive income, I taught you some rule. What's the rule? If it is not connected to a PE, if it is not effectively connected to a PE, then both countries shall tax it. Do you remember? Limited taxing right. Do you remember?
Yes.
Meaning that the source state will tax you at what? A limited rate.
More than
And also a
10%.
smaller rate. And the resident state will tax you fully, but will grant you a credit or an exemption. Meboa. So if it's not connected to a PE, this is the rule. But if it is connected to a PE, how would it be taxed? If it is connected to a PE, how would it be taxed? I taught you here now.
It will be taxed as a business income.
It will be taxed as
Article
business income
7.
or business profit, right? So far as it is connected to a PE, whether it is interest, dividend, royalties, fees for technical services, so it will always be taxed as business profit. So far as it is connected to a PE, that's a rule. Makes sense? So this is the principle of who has the taxing right. Okay, now that even though you say that you don't get a full mark, all passive income questions, this is a rule. You always need to explain the concept of beneficial ownership, stating who has the wider control. So there are some things you need to identify beneficial owner. Okay, always state who has the ultimate control. Do you understand? So who controls the actual thing that is going on? Who receives the economic ownership, right? So who has the wider control? Okay, or the wider benefit? And finally, who has the what? The narrow control. So the narrow control is the special purpose vehicle. So if the US company now acquires what? The Ghana company, I get it, let's say acquired 100% of the Ghana company. The Ghana company acquired what? 40% of what? ABC, another Ghana company. Okay, let's say 40%. Who has the wider control? Is a US company. Who directly and indirectly controls all of them? Is the US company. He has the what? The ultimate control and the wider control. Who has the narrow control? Is this guy, right? He controls 40%. So he becomes a special purpose vehicle who just transports the dividends or interest or whatever to this guy or royalties. Do you get the idea? So you have to do these three tests and you have to actually write it in the answer so to get the mark. They always allocate about 5 marks for just the allocation, the identification of beneficial owner and treaty shopping, just mentioning them in the case keke. 5 marks, they are for free. Hello. So you can't do passive income, interest, dividend, royalty, fees for technical service without mentioning beneficial ownership, without mentioning treaty shopping, because sometimes they'll be hidden in the case. Hello? Are you getting it? And you must tell the examiner that the state in which the recipient, the beneficial owner is located, the DT of the beneficial owner in the payee state will be used. So if you can explain the concept of treaty shopping and also let the examiner know that the term is not defined in the treaty. Do you understand? So further, students must what? Explain the treatment of passive income where it is found that the beneficial owner has a PE in the source state. It will be treated as business income, you remember? And the income that is effectively what? Connected to the PE. Makes sense? So this is a rule. Always identify the beneficial, identify whether there's passive income, then immediately you have to talk about the beneficial owner. I get to it. Who has the taxing rights under the DTA, concept of beneficial ownership. I get in it. The concept of treaty shopping and the rules of taxing it, right? That you give your conclusion. So when we identify the beneficial owner, I told you that we must always what? Look at who controls the income ultimately, who has a narrow interest, which is a special purpose vehicle, and who has a wider interest, right? So that is it. So this question came, I think, somewhere, was it 2021 or something? I forgot. It's been a while. I get it. But then let's look at it if truly we can understand what is going on. Now, Mavi Limited is a resident entity in Ghana. Now, Mavi Limited was established 7 months ago when the coronavirus pandemic began. It sells personal protection equipment, including medical sanitizer, face and nose masks for self-protection against the infectious disease. Now, the company was jointly owned by ERA Foundation and Akusa SA on 40 and 60 shareholdings, respectively. So if you look at it carefully here, let's draw this thing very well. Please, are we learning something? And I am Pong.
We are learning, no?
Oh, let's close it.
Carry on, carry on.
All right, so let's see. I told you anytime you see group structures in questions, what do? You draw the structure. So here they said what? Mavi. Where is Mavi located? In Ghana.
Prof, do you draw it on the answer booklet?
Of course, why not?
Oh, okay.
Share. Also, any brio. Now, me organizational iceberg. No, ma draw na share. Organizational iceberg. Ma drop and ma draw obi or oti boats mu. Or no 5-star energy. Share. They were named. Or no 5-star energy drink. You don't know. You must do what it takes to pass. Oh. Pour out your knowledge. Time yourself. You get. So they are saying that who and who owns Mavi. Who and who owns Mavi? They say Akusa SA. Akusa SA owns what?
60%.
60%, right?
Area
Okay.
Foundation 40.
And ERA Foundation also owns what? 40%, right? Okay, good. We are there. Now, it tells us that what? ERA Foundation is a resident in Ghana. So ERA is in what? Ghana. Good. Sister New Belgium.
London.
All right. Wait there, Belgium when you're London. So ERA Foundation is resident in Ghana. I'll come and prove something to you later. Now, they also said that what? Akusa SA is a company resident in South Africa and is 100% owned by CPL Group. So now what is happening? Akusa is also owned by what? CPL what? Group. Who is located where?
Netherlands.
In Netherlands, right?
Netherlands, yes.
Okay, but Akusa is where? South Africa. And this guy owns 100% of this guy. No be so. So look at what is happening here. This guy owns this guy who also owns 60% of this guy. Can you see that? So let's look at it well. So it means that CPL acquired what? 100% of what? Akusa. Right? And then Akusa also intended acquire 60% of what? Mavi. Then we also have what?
Consopan or you know.
We have ERA who also acquired what? 40% of what? Of Mavi. But here lies the case. CPL is in Nether. Akusa is in what? South Africa. Mavi is in Ghana. Aira is in Ghana. And Mavi is also in Ghana. So the examiner intentionally hit Ghana to tell you that this thing isn't no more than 25%.
Yes.
And what's the rule we saw under section 59.3?
Exempt income.
Exempt income.
Yes.
Dividend.
Yes, where you acquire at least 25% of the voting rights. When Mavi now pays dividend to Aira, what will happen? It will be exempt
Be
from tax.
exempt from
You
tax.
see how it was hidden in the scenario. So the
Wow.
things is not outside what you, the knowledge you are applying. But most people who answered only talked about the treaty shopping and the things. They never even saw this one coming. And this was a hidden gem in there. This was a bright price in there. You get? But let's see. Could there be instance of treaty shopping? Yes, there could be. It could be that CPL has seen that the provision between what? South Africa
South
DTA and
Africa.
Ghana DTA is favorable. Not so. So he wants to take advantage of it. So I told you that always identify the beneficial owner. In this case, who do you think was the beneficial owner? CPL, right? So what are the three tests I told you to do? One, who controls the income ultimately? Yes? Who controls the income ultimately?
Akusa.
CPL. Why? Why Akusa? Income ultimately. Now say Akusa.
Okay. Yeah.
That's the CPL because he directly what? Owns whatever Akusa has, all of it, and indirectly controls whatever Mavi has. So he indirectly controls it. Who has a wider interest?
CPL.
It's CPL because he owns 100%. And who has the narrow interest?
Akusa.
Akusa. So it tells us that Akusa is simply what? A special purpose
Special
vehicle to
purpose
use
vehicle.
what? Transport benefits to CPL. So in that case, it could be an instance of treaty what? Shopping. Then you explain to the examiner that treaty shopping is the case where somebody's country is not a party to the treaty, but he's enjoying benefits, even though it's not defined directly by the tax treaty. Imagine.
Prof, fortunately, but true.
What's a Montro. That's why I'm here for you, right? Don't assume the examiner never knows. Why am I may draw diagrams? It tells you how important the diagrams are. Don't try to be a hero in exam.
Prof, Mbacho diagram, how many marks?
Oh, dear, draw. Oh, dear, draw diagram. No name the entire. It guides you. Do you understand? Even if no marks are there, it helps you because a man who structure ni ye. Right? You can say one, determine group structure. Then you write it nicely there. I mean, it doesn't hurt a fly to do that. Rather than having 100%, no, sir. Yeah, you're planning. No. Do you get it? So now, the whole thing is that, let's see what happened. They said in the last 6 months, two technical experts from CPL visited Mavi. Technical experts, that's from the ultimate parent. They visited Mavi on 3-month rotation basis to provide technical support to the staff of Mavi. So this one, I can decide to attack it from UN perspective or attack it from OECD perspective. Let me explain. Let's first start with what? OECD. Now, from OECD doesn't recognize something we call service PE. Okay, so OECD will say that Unimbibi, so two technical experts no mobile Mavino. Won't they get a place? Won't they get a fixed place to work? Corner office or something to work, right? So there will be a fixed place at the what? Those technical experts what? Disposal to work, and those technical experts are also dependent agents because they came to do what activity for who? For CPL, not Mavi. For CPL, they came to habitually or do this on behalf of CPL, and there would be a fixed place available to them. So it creates a PE. That's from OECD perspective. Okay. Now, from UN perspective, how does this create a PE? If I bring technical experts on 3-month rotation basis, it means it becomes 6 months, right? And for a service to create a PE in the UN model, it must have been 183 days or more. So 6 months will definitely be 183 days or more. On 3-month rotation basis, it tells you that it has hit 183 days or more, so it creates a PE. So if that is the case, then a PE was actually connected with MAVI. So any dividends that would be transferred to Akusa through to CPL would be taxed as business profit where in Ghana. Meboa. But you must still state the rule that if the what you remember now, the dividends that Mavi will pay will be connected to a PE, Meboa, of CPL.
Yes.
So it shall be taxed where the PE
That's
is
what I'm
located,
saying.
which is where? Which is Ghana. But if it wasn't connected to the PE, then Ghana will tax it at a lower rate, but then Netherlands will also tax it what? Fully, and then what? Grant CPL what? Credit. Nti adeɛ na ɛno ani o. Now when you're 20 marks. Oh, cool, baby. Question will be a friend main jam a home cover girl for fro. You understand? Yeah. So passive income is a rule. I told you some rules in passive income questions. Beneficial ownership, treaty shopping. See, when you see interest, you see royalty, you see fees for technical services, you see dividend. These are the things we need from you. And last night, do you know last night, the thing pained me, the thing shocked me. Adeɛ wei da hɔ paa na obi ehu adeɛ wei paa wankae. Hey, ɛbɛyɛ yie. Wokɔ exam no na question ne ba na unhu so ɛno ansa watie mempini o mempini ma monka menhyio. Mempini ma monka wo nhyɛ wae. Wobɛpia na wepie. You've done your part. All right. Unim sanka exam ɛnyɛ den. Do you know that? Exam is not difficult. Now you want write correct answers. That be why. Now person throw correct answers. Exam de anka ɛnyɛ den. Meboa. Exam de sanka ɛnyɛ den. Una person will throw correct answers. Anyway, let's just leave it that as it is. All right. My big man. Income from employment. Now, let's deal with income from employment. This one of the areas that they like bringing questions a lot. This diet possibly, why not? Because there are some articles that directly go with Article 4, residence, and employment is one. Somebody asked a question on the page today regarding the 183 days, and this is where mostly we use the 183 days, right? Now, employment income questions, Sankasan, there's a structure, there's a way you can make the marks, all right? And let me show you the nature. I think February 2026, was it February 2026? Yes. They brought for the first time, they brought, what do we call it? Stocks, okay? They brought stocks. So let me see, where is employment income? Let me go through my question bank and see. Yeah, so let me go through my question bank. Okay, permanent establishment, artists and sportsmen, Article 8, employment income 138. All right. Okay, so 138, yes. So my question bank, we can see it here. It gives us the exam approach first before it brings questions. So exam approach, step-by-step analysis. So the key points are that when you get Article 15, okay, it deals with employment income. Now, you must always tell the examiner that in the UN model, employment income is referred to as dependent personal services. Are you following? Are we following? And what are the key considerations? You must first understand the DTA provisions relating to employment income. You must be aware of the domestic tax rules governing employment income, especially if Ghana is involved. Then you must refer to Article 4. You must know all the rules. Then in case they tell you that the person even has what he has been given a house, it's a non-cash benefit. He has been given a vehicle and a driver. You know those things, right? You're supposed to know them. Always refer to both the DTA and the domestic tax laws when answering employment income questions. Only when Ghana is involved, because I don't think you know the rules in South Africa. So don't go and say the domestic laws of South Africa. Do you know what South Africa domestic law says? You don't know. Do you get it? So what's the general taxing principle? The way they write it makes it quite confusing, but the whole thing is that wherever you exercise the employment is wherever we tax you. What did I say?
Where the employment is exercised.
Yeah, it's where we tax you. It's that simple. But then when you go to Article 15.1, it tells you that the resident state of the employee has the exclusive right to tax the employment income unless it is exercised in another country. It's still the same, right? Definitely you exercise the employment somewhere. Because if you look at it logically, if you're a Ghanaian and you work in Ghana, we should tax you in Ghana. But if you exercise employment somewhere else, then we should tax you in that somewhere else. That's all. Right? So if the employment is exercised in the source state, that is where you carried out the employment, then the source state may tax the income unless you qualify for an exemption. And what is that exemption to the source state taxation? So let's say that I'm a Ghanaian, but I'm working in the UK. UK is supposed to tax me, but however, UK will not tax me when I meet some criteria. And what are the criteria? We have the physical presence test, the employer payment test, and the permanent establishment test. And this same rule is what qualifies for exemption under Section 111, subsection 2A of the Income Tax Act. Okay. So you mix those principles together, and then you don't hear any issue. All right. So let's understand the rule first. Wherever you exercise the employment is where we tax you. And also, wherever you exercise the employment can also exempt you from tax if some criteria are being met. So if you are working in the source state, you will not be taxed if all of the following conditions are met. Right? 1, the physical presence test. You must not be present in that state for more than 183 days in a 12-month period. So look, if I'm working in the UK, but as a result, even though I'm working in the UK, I didn't stay in the UK for 183 days or more. It means I stayed somewhere else. That somewhere else must tax me. 2, if the remuneration, that's the salary, was not paid by a UK citizen, but rather someone outside the UK. And 3, my salary was not borne by any branch or office or PE in UK. Do you understand? Then I can't be taxed in UK because there's no nexus in the UK. Does it make sense? And you know the funny thing? You see this thing that we are seeing? One died. Just these 3 factors came for 15 marks. They just told us that under what circumstances will somebody be exempted from employment income in the resident state? 15 marks. So 1, 2, 3, 5 marks each just by listing. So international tax and yes, a rules no. What the rules now? Yeah. You are good to go. Okay. Did you understand? So 1, if I'm working in the UK, I didn't stay in the UK for 183 days. The person who paid my salary is not a citizen of the UK. And my salary wasn't paid through any branch in the UK. That means I was not literally in the UK, right? In substance, it means maybe my contract is in the UK, but it really tells me I wasn't really in the UK. Understood? So should UK tax me? No, sir. UK shouldn't tax me because I didn't really have a connection. So even if the PE does not deduct your salary as a business exemption, the exemption will not, business expense, the exemption will not apply. Do you get the whole idea? So these are the rules you need for employment income. Okay. So what key considerations do you have to meet? If all 3 conditions are met, the exemption applies and only the resident state taxes the employment income then, because you are exempt from source state taxation. If any one condition is not met, the source state can still tax the income. So look out for employer structures. Like if the employee is working for a subsidiary or branch in the source state, then the remuneration might be considered borne by a PE, which means taxation applies in the source state where the PE is located. Do you understand? So some countries override the treaty provisions through their domestic laws. Example, a country may tax all employment income derived from work performed within its borders, even if it's a 183 days rule. Are you getting it? So there's the exam strategy or how to approach income tax question, employment income question. That's under Article 15. You must identify the resident state of the employee, determine when the employment is exercised, check the 183 exemption, assess whether the employer is resident in the source state, determine if the remuneration is borne by a PE in the source state, and conclude whether the resident state or source state has taxing rights. Are we okay? I sent you a video, the very first, I sent you a video on foreign tax credits. Were you able to watch it?
Foreign tax credit.
Yes, that was the very first. Okay, and the China 50 marks now on but major. Don't learn how to calculate. Don't learn how to calculate foreign tax credits. Anyway.
The DT, is it not the double taxation video?
Relief. Yes, the credit. Section 112.
Yeah, we've watched it.
You've watched it. Oh, thank God. Rema, open our own share you. You watch it. Average tax rate in the foreign country, average tax rate in Ghana, right? You compare, then you pick the lowest there. So, all right. So when they tell you that they pay the employee stock options, how do you tax stock options? For the very first time, they brought stock options, and this can be found in the commentary. Right now, stock options granted to employees are considered part of the employment income under Article 15. So the taxation of stock options depends on where the employment services are performed during the vesting period. And it actually depends on the grant date, the vesting date, and the exercise date, or sometimes the sale date. But don't worry, this is all you have to say. I won't bombard you, right? So anywhere you exercise employment is where we actually tax your stock options. That's all. So these are the rules to employment income that I need you to understand, right? So the rest, you don't really need it. Now, you see February 2025, you see, Dennis and AC, they brought this question. Looks so long, but it's empty. All right. So Dennis and AC salary and stock options. Detailing the respective taxing rights of Ghana, Belgium, and the UK, any compensation that AC might receive from Luminous Corp. 20 marks. Employment income. So employment income is one of the areas that you have to be very sharp with, because employment is one thing that every taxation exam is concerned. So those rules we learned, you must have them at the back of your hand. Let's go to the Income Tax Act. Specifically, I want us to go to let me see if I can find the Income Tax Act. Yeah, yes. Let's go to section 111, subsection 2. But I hope you all know the definition of PE in the Ghana tax laws under section 110. That thing, they can bring it every night. Simple. No long way. They'll just tell you to talk about what? Ghanaian PE, foreign PE, and an owner. I hope you can do that when it appears. I hope you can do that when it appears. Okay, section 111. Foreign source of income of a resident, or foreign source income of a resident. This is where it gets interesting. It says what? The income of a resident person derived from a foreign source is taxable. Despite subsection 1, the income of a resident individual from employment exercised in a foreign country with a non-resident employer or with a resident employer where the individual, are you getting it, is present in the foreign country for 183 continuous days or more during a year of assessment is exempt. So this is an exemption. This is where it gets interesting. So when you're answering employment income questions, also look at it. Was the person a Ghanaian? Okay. And did he stay in a particular country and was employed there? So if he was employed there and they paid him some money, all right, that money, when he brings it to Ghana, he's exempt only if he was employed with a non-resident employer. Or 2, even though he was employed by a Ghanaian employer, he stayed outside Ghana for 183 continuous days or more. Do you understand? Then this creates an exemption. All right, so are we okay with employment income? So these are the rules you use to answer questions. Okay. Now, what other article do you need help with? Then I close. The rest, I already sent you videos in the morning.
Special provisions.
Exchange of information.
24 to 27.
24 to 27. I sent you a note on 20, 24, and 25. I'll send 26 so that you read before you sleep.
Okay.
I need proper articles that I can weigh. Okay, so they can ask you.
International air traffic. Article 22.
Capital. Oh, taxation of capital is the easiest article, so they won't even ask you question. Capital is taxed according to the income that is attached to the capital. That's all.
Okay, so what of teachers?
Teachers.
Yes.
Okay, so the whole thing is that if it comes to teachers, right, there's an exemption rule, but the teacher must be in respect of research work. All right, so
Okay.
let's go and look at it. You see what you guys are doing to me. Mom person me rest. Let's go and look at teachers.
For me, no embarrassing.
Okay, let's look at fees for technical services now. Article 12, Article 12B.
B.
That's international taxation, you.
No, I don't know to know.
Yeah, but
I don't know to find.
Yes, you are there. Yeah, there. In just 3 days. Yes, you are there. Huh?
yeah,
Sorry. Yes, you are there. Yes, you are there. Ebi muti paya omo dada. Mpesa mdi bi beka.
Oh. Me center na so much jegu.
Okay, so
The center of my head.
okay, so fees for technical services. Now, when it comes to fees for technical services, right? Most of the time, all right, what you need to understand is that they will give you two particular transactions that a bank or some firm has done, and you have to assess which one looks like fees for technical services. So I want to take the time to just explain it briefly, and then I think we are good to go. Before I come and talk about the teachers and the students, right? For artists and sportsmen, I've already sent you a video on that. Make sure you look at it. Are we okay? But what we've done, I mean, I'm very confident actually. I know says some 60 marks to 70 marks be there. Right? Then the interpretation of treaties, the very first video I told you, it's there. But maybe I will send you a summary of how to interpret tax treaties, like the way I'll send the exchange of information. If you are interested, I should send it, right? So that last minute, maybe tomorrow early morning, you can just walk your eye through. Yes.
Yeah.
Because us at this point, me foresee Bioma off. I've been teaching for 1 whole year, no rest. It's very bad. It's very bad. It's very bad. 1 whole year. The funny thing is no rest. Teaching and coding at the same time. Who said that form? Me pompe me sanko to your app ne so, Charlie.
I was saying for vacation me.
Oh, Charlie.
And they'll call a value.
Oh, but for angel fetri keke kan why? All right. All right, please let's continue. Now,
hello, Prof.
Yes, please.
Prof, please, yesterday you made mention of Article 12B. You said today be touching on it.
Oh, I realize that the examiner will not ask you anything on it, so let me not stress. Let's just do what you need for your exam, right?
Thank you.
All right. So, Article 12A, fees for technical services, right? Now, in its 2017 update, and this only in the UN model, right? So some students saw, like one student bought my book, okay? I think this has been on 3 occasions, and they said, I have made a mistake because one question said Article 18, entertainers and sports persons. Why didn't I put 17? It was a typo. And I said it's not a typo. Let me show you something. Anytime they introduce these fees for technical services, right? Sometimes it shifts the article numbers. Do you get it? So a DTA, which had royalty as Article 12, because they don't want to spoil the flow, they rather make this Article 13. Do you get it? So the 14 now becomes 15, 15 becomes 16. The 17, which is artists and sportsmen, now becomes 18. Do you get it? So sometimes the article names don't follow directly so far as they are in the DTA. So some articles, when they introduce, I've seen articles where the teachers and then professors are Article 12A, like they are Article 13, and the capital gains now rather becomes Article 14. Do you get it? So it can be shifted. All you need to know is the name of what they are telling you, not the name of the article. Because some DTA, you go and see article 8 rather as business profit. Do you get it? So get that. So don't go in there and think that the article number that they told you, look at the name of the income they mentioned. And yes, sir, we Diego. We can never back and show stomach naka.
Naked.
Crop top. So what I say, so be careful. Don't just follow the article names. Follow the name that they attach. So they can tell you article 20, taxation of teachers. Another time you see the same article 20 as taxation of students. Do you get the idea? So look at it. And any income which is not in the DTA, listen carefully. Any income which is not directly identified in the DTA, but is direct income, like it's income. I get it. It will be taxed by the resident state. But if it is connected to a PE, it will be taxed where the PE is located. That's how we tax other income, and that's in under Article 21. Okay, resident state has primary taxing right. If it's connected to a PE, it is taxed where the PE is located. Simple. Titia, fe. All right. So, what is fees for technical services? Now, FTS is defined as payment for managerial, technical, or consultancy services, but excludes payment to an employee. So, if you are doing managerial, technical, or consultancy services, it is fees for technical services. But when you are paying an amount to an employee, are you getting it? Or you are teaching, you are paid for teaching in an educational institution, are you getting it? Or you made payment to an individual for personal services, they do not constitute fees for technical services. So when you say management services, anything that involves the application of knowledge, skills, or expertise in control or administration or the conduct of an enterprise, as management as you are, right? If you are the manager, you are offering a technical service. If it is a technical service, applying specialized knowledge, skill, or expertise with respect to a particular art, science, or what profession. So fees received for services what provided by regulated professions like law, accounting, architecture, medicine. Are you getting it? All of them will constitute fees for technical services. So when we say consultancy, we mean what? Provision of advice or services of a specialized nature. So let's look at some simple rule. So how do we tax fees for technical services? It's just like royalties, right? Under the OECD model, fees for technical services are considered royalties. And what's the rule for royalties? One, if it is not effectively connected to a PE, it will be taxed what? By both states. Resident states will tax it fully and grant you credit. Source state will tax you at a limited rate. Meboa.
Yeah.
Yes, so both states, if it's not connected to a PE, both states will tax it twice. Do you get it? One at the source state at the lower rate, resident state fully, then you get the credit. But then if it is effectively connected to a PE, it will be taxed where the PE is located at business income. That's the rule. But then how do you identify whether itself is what? A fee for technical service, right? So let's see. Our company is a financial institution resident in state R. Our company provides a wide variety of financial services to customers, including acceptance of deposit, extension of credit, guarantees, foreign exchange, negotiable instrument, right? Now, is this thing not what the normal banks do? Is it not what the normal banks do? So should it constitute technical service?
No.
No. But our company's business is conducted primarily in State R, but it also has clients in other countries, including State S. State R and State S have a tax treaty. Are you getting it? That contains an article akin to Article 12A. Payment received for services provided by financial institution will constitute fees for technical services if the services involve the use of knowledge, skill, and expertise to provide research, analysis, or advice to a specific client related to particular circumstances. This has to be distinguished from the provision of non-specialized services, such as payment and transmission services, debit and credit card services. Do you see? So based on what we have just learned, when we are looking at this question, let's see. So Global Trust is a financial institution resident in UK. The bank provides a wide variety of financial services globally, including the acceptance of deposit, extension of credit, foreign exchange transactions, and the issuance of guarantees. Although Global Trust Bank's primary business operations are conducted in the UK, it also serves corporate clients in Ghana. So the DTA between Ghana and the UK contains a specific article granting Ghana as the what? The state of source, taxing right over certain what? service income, right? This article is modeled on Article 12A of the UN model, which deals with fees for technical services. So during the year of assessment, Global Trust Bank received two distinct payments from a corporate client in Ghana. One, payment A, fees received for managing the client's high volume payment transfers, debit card and credit card services. Does this constitute FTS? Does this constitute fees for technical services?
That's
Yes.
the normal operations of the business.
Yes, it constitutes.
Hey,
That's the
banks,
normal
look at
operations
it
of the
carefully.
bank.
High volume payment transfers,
It does
debit card,
not.
credit card services. Did you use any technical know-how here?
No,
No.
so I didn't see
So
that.
why? But look at the next one. Fees received for conducting in-depth, tailored research and analysis of the client-specific investment portfolio, for providing specific strategic advice on mitigating foreign currency exposure. Does that constitute fees for technical services?
Yes.
Yes. So that's all they're asking you. Define the term and declare which payment A and payment B, which of them constitute fees for technical services or business profits, right? And the tax consequence. So which of them is business profit and which of them is fees for technical service?
Payment A is business profit and
Payment
payment
A
B
is
is
A.
fee
business
for
profit.
technical
B is
service.
fees for technical service, right? And then what's the principle that we use to what? Tax them. Then you just talk about them. When it's not connected to a PE, when it's connected to a PE. Then you get your marks, then you are gone. That's all about fees for technical services. All right, so Mapong. Oh, you said teachers, eh? Yes.
Yes, sir.
Please, can we have the solution for this one?
That's what I've explained. I'm moving on. I'm not looking at any solution. I've given
So
you
please,
the.
the taxing right for the technical service, technical and
I
management
said
service.
it's just the same as royalties. We've explained the taxing right several
When
times.
there is a PE, okay.
When it is not effectively connected to a PE, both states shall share the taxing rights. Third state will tax you lower. Resident state will tax you fully and you get a credit for it. Not so.
Okay.
But
Do you get
Prof, if I may ask, I thought there was a provision from OECD which allows only the receiving state to tax royalties.
Yes.
Yes,
And
but
UN.
this is not royalty. OECD does not have fees for technical services. It's in the UN. That's why I didn't even mention that provision. Do you understand? But in case they say
Okay.
OECD, then the fees for technical service must qualify as royalties. Then it will only be, if it's not connected to a PE, it's only taxed in the resident state.
Okay.
But OECD doesn't have this. It's the UN model. Are we okay? Ruby, are you okay now?
Yes.
Yes, sir. But to add to what he was saying, I read somewhere that
Where is the somewhere? You people always say I read somewhere.
it will be taxed on the states. It will be taxed in the receiving states. So the states in which the consultancy and the technical service take place, so that is the state which should be taxed. But with what you've just explained right now, I think it will be taxed in the resident state. But when there is a PET, it will be taxed in the source state. I sort of agree with what you're saying. So what he meant, I wanted it to clear much on that one. So.
That one is the OECD. In OECD, there's nothing like fees for technical services. The OECD considers fees for technical services as royalties, so still uses the same royalties principle to tax it. That's what we are saying.
Okay, thank you.
Are we okay? You're welcome. Okay, so now let's go and look at which one are we looking at? Teachers, eh? So teachers, check. Okay. Well, there are more areas, no. Okay, so please, interpretation. Oh, what is this? Interpretation of DTAs. Okay. I'll close right now until the main run to interpretation of DTAs. life cycle of DTAs. I hope you all know the life cycle of DTAs. Negotiation date, signature date, ratification date, entry into force, implementation date, termination, right? Termination of DTAs. Please, are you following? Montro. So with the
Prof,
first video, it was there.
Prof, I saw in one book a need for assessment before the negotiation. Is it really?
Yes, because you must assess whether you need the DTA before you enter into it.
Okay.
Yeah, of course.
Thank you.
So that you must first have the idea. And yes, sorry, I enter. No, we must first sit down. So termination of DTAs, interpretation of DTAs, life cycle of DTAs, termination of DTAs, the methods of relief, right? So these methods of relief is possible. It may come as advantages and disadvantages, which I know in the first video we covered all that. I get in. Then foreign tax credits. So these are like the basic international tax rules, which I believe everybody on the call knows about. I get it. Then there are special provisions like exchange of information, mutual agreement procedures, non-discrimination, then assistance in the collection of taxes, right? So this assistance, which can be found under Article 26, I get it, 27, sorry. You can also find a portion in Section 98.3, okay, of the Revenue Administration Act that the Commissioner General, okay, can take money from somebody who owes another country money if only it is mandated, right? So if a UK, Her Majesty's Revenue and Customs have a tax debtor here, GRE can take the money on behalf of the UK government. Okay, so they can also ask you that. So these areas, I'm expecting some 15 to 20 marks from these areas that I've given you. If you can't answer it, you just leave it because you still have 80 marks. You know. Send the exam, Missy exam, and yet they won't help us or correct answers, Cynthia. It's open no wager. So I've given them to you, right? Okay, so let's go and look at our Article 8. I sent you a video on that, right? I think so.
Immovable.
No money there does. And I'm just using you had the whole 3 to 4 months to learn. I think I may be oh how? What be that? When now who be that shine your eye? When now TV that students and apprentices. It has never been examined before, but I'll still talk about it. Teachers and professors 162. Let me go there and see what they have for me. Yeah. Teachers and professors are shifted. So what's the rule? The exam approach for teachers and researchers or professors, right? So exam focus. Teachers and researchers may be exempt from taxation in the source state if certain conditions are met. And the primary taxing rights remain with the resident state unless the conditions for exemption are breached. So this is what happens. So there are some key conditions, right? The nature of the activities. It must involve teaching or research in an educational institution. It must be a recognized institution, meaning that the work must be conducted in a recognized institution, educational institution, or a research institution. And the duration, it must not exceed 2 years. Okay? If it doesn't exceed 2 years, you're exempt. Only the resident state will tax you. But if it exceeds 2 years, all the years from year 1 up to the year, whatever, will be taxed. You get a rule. And then if the research is of public interest, that's where you qualify for exemption. But if the research is sponsored by a private entity, then the exemption will not apply. If the research directly benefits that sponsor and the outcome is sold and you gain financially, then that one, you will not get the exemption as well. So if the private sponsor funds the research as part of his CSR, I get it. The tax authorities will what? Assess the outcome of the what? The benefits, whether it benefits the sponsor. I get it. And if the research you sell it and you make profits, that profit will be taxed. If it's in the form of royalties, it will be taxed under Article 12. If it is in the form of business income, it will be taxed under Article 7. But if you're a professor, you can invoke Article 4.2, where they are going to use the tiebreaker rule to actually elect you to be taxed in your resident state. I get it. So when it comes to this kind of questions, verify whether the teacher or professor is engaged in teaching or public interest research, confirm that the educational institution is recognized, check whether the contract duration exceeds 2 years, and assess whether private sponsorship creates taxable benefit. Determine if the research outcomes are commercialized and taxable, and under which article, right? And consider if the professor can invoke Article 4.2 and use what the tiebreaker rule. So look at Professor Elikem, distinguished professor in African traditional music in the University of Ghana. As part of an agreement between the University of Oxford in the UK and the University of Ghana, Professor Elikem was invited to the Oxford University in 2019 to teach and research into indigenous Ghanaian African songs, right? Now, do you know what they would do? You see the way Professor Elikem has come like this. CIT can just say that Professor Elikem also went to sing in a live show in the UK. So you see they've mixed professor and also what? Musician together. Have you noticed? So all you have to do is don't be scared. Treat them as two separate things in one scenario. So you say artists and sportsmen, Article 17, then you talk about it. Then you say what? Teachers, then you talk about it. Then you conclude and give maybe what? Residents, then you talk about it, then you are done. Anything you spot, don't say that, oh, they say anything you think it is necessary for the case. You underline. That's how we pass. Don't assume the examiner knows you know that residence is part. No. Write it. Because I don't know unless you prove to me. Me papa a despite, prove to me. You understand? So if the world was mine, I will share. Prove to me. The world is not yours. So let's see. You understand? So that's the idea. So na do so do. My brain.
So
Professor Elikem is a distinguished professor. So in African traditional music in the University of Ghana. So as part of the agreement between University of Oxford in the UK and the University of Ghana, Professor Elikem was invited to the Oxford University in 2019 to teach and research into indigenous Ghanaian African songs. So Oval Records and Music Limited, a United Kingdom resident company, offered to fund the research into indigenous songs to be carried out by Professor Elikem for additional year, which was agreed by the university and the professor. So the professor was paid for all the relevant years for the research and teaching by the university. So you see, he stayed an additional year, which means that he should have been exempted for 2 years, but that additional year means what would have happened? He will now be taxed on all the years. So as a result of what? The special skills of Professor Elikem in African music and dance, Oval Records and Music agreed with the professor to perform songs composed in connection with the research he conducted in the University at Guftan Hall in London. The professor was paid directly by the company for his performance at the Guftan Hall. You see? Said the American and Abim. So what two articles are we talking about here? Professors. So you have to talk about all the principles. That one, it must be a recognized educational institution. It must be in relation of research or education purposes, right? At the end of the day, he's only exempted for 2 years, but if he stays extra years, the whole of the period will be taxed, right? And then the research that came, the outcome, was it sponsored? That sponsor, did he get any private benefit from it? Yes, they did. That makes it taxable. It means he's exempted from that word, exemption. It means he will be taxed, right? Then also, if the outcome of the research is commercialized, it is taxed. But this time it will be taxed under Article what? Article 17. You get it? Then you talk about the rules that where the public performance took place is where we end up taxing the person. What?
Prof, is there a specific article for professors?
No, this article has no home.
Mm-hmm.
That's why you never see it can be 20, sometimes it is 12, sometimes it's 13, sometimes it's 19, sometimes it doesn't even have a name.
Okay.
Yeah. Now, let's come to taxation of students. If you're a student or an apprentice, right, and you are in another country, okay, so far as the income you are receiving came from a non-resident country and it is solely for your maintenance, like taking care of yourself, are you getting it? Then that income is exempt from tax. Did you get me? But however, if you are in that country and you are also working, then that income that you are getting from the employment or business will be taxed according to Article 7 if it's business income, or will be taxed according to Article 15 if it's employment income. But if I'm giving you a monthly stipend of $500 or £500 every month, and now the monthly stipend, I didn't inform the tax authorities, and I now make it, let's say, £10,000, that's huge money. The tax authorities will consider the nature of the amount. Are you getting it? But then, any amount that comes from a non-resident, if you're a non-resident of, let's say, another state, which is Ghana, and then you've gone to what, the UK to learn, and as a result of learning in the UK, they send you some monies to maintain yourself. They are all exempt. But if you are engaged in what, employment there or business there, to be taxed in those corresponding articles. Did it
Prof,
make sense? Yes, please.
please, is it in this scenario, let's say Professor Elikim,
Mm-hmm.
in his situation, can he elect to be taxed in
Yes, he
Ghana?
can elect to be taxed in Ghana, of course. But in respect of the performance there, the public performance took place in the UK. So that one there, he has to be taxed there.
Okay.
Questions, Nina, they look the same. International tax there. You know, me person, me share many question on student. I told you students have never been examined before. Do you remember? Yeah, but then I want to take an actual question. If it will come, how it will look like, right? So let's see. Veronica. Auntie Vero. Let's see Auntie Vero. Okay, good. Oh. Okay, it's done. All right. Veronica is a citizen and tax resident of Ghana. She's employed by Medtech Ghana Limited, a pharmaceutical company, and has been selected for an executive certification program at Cambridge University, UK. Now, as part of her qualification requirement, she must undertake a 3-month internship at Big Pharma, a multinational pharmaceutical company based in London. Where they have in a sister New London. Now, during her stay in the UK, Veronica receives the following sources of income and benefits. 1, internship stipend. Now, Big Pharma pays a stipend of £500 per month. Maintenance allowance. Her employer, Medtech Ghana, provides her with a monthly maintenance allowance of $1,000 to cover her living expenses while she lives in the UK. Employment benefits. As part of her internship package, Big Pharma provides her with free accommodation in a company-owned apartment in London and assigns her a company vehicle for personal use and professional use. Business activities. During her stay, Veronica identifies a business opportunity and registers a sole proprietorship in the UK, importing Ghanaian, or should I say Ghanaian organic skincare products. In the last month of her stay, her business earns a profit of £10,000 from sales in the UK. Ghana and the UK have adopted the OECD model in their tax treaty. Veronica is expected to return to Ghana after her internship and continue employment with Medtech Ghana. The UK has tax rules concerning employment income, business profit, and residency-based taxation. So when you get questions like this, each income itself, you have to talk about it. Internship stipend, taxable or not taxable?
Not taxable.
Not taxable. When does it apply? 1, she's a resident of another country, which is Ghana. She came there solely for apprenticeship, right? And the income that they are giving her is for a maintenance or only a scholarship, internship. So it shouldn't be taxed. So something like the internship stipend, not taxable. The maintenance, not taxable. But what about the employment benefit?
Taxable
Taxable
under
under
UK
Article
rules.
15, right? Article 15. Then the business activities, taxable, right? Under business profits. This thing has never come before. So imagine how many students will be taken by surprise if they should go and then for the first time, they ask you Article 20 students. the people will be confused, but it's very easy. Now, the rules of the Income Tax Act is also the same. If a student also came from outside to maybe study in the University of Ghana and they are giving her some monies and some other things, and that Section 7 is completely exempt. Somebody studying under a bursary or a scholarship scheme under Section 7 is completely exempt from tax. So that brings us to the end of our international tax session. Yay! Now, I am going to send you the information that was required for the interpretation of DTAs, for the exchange of information, including depository for institutions and those things, the ones with reporting obligations, right? The assistance of taxes, I get, and then diplomatic mission. So I'll send you those ones. Then I think early in the morning, you can just walk through before you go and sit down. Are you getting it? Because it's reading, I mean, it to be fresh in your head. So our intervention has come to an end. It was wonderful meeting all of you. And
God bless you.
I wish to see you all with good news so that final 2 we can walk on the ladder and pass 3, except you want to write less than 3, which I don't advise. You can all pass as one family. May the Lord be with you once again. I pray the good Lord.
Thank you. God bless you.
I pray the good Lord will grant you your heart desire this day. If I be a child of God, then this day I pray for a no failure seal on you. May the angels go
Amen.
and guide you through. If
Amen.
wherever I turn, I prosper, tells you, because nobody has met me and him or his life has ever been the same, because I'm a blessing child. This day I bless you in the name that is above all names. Go and pass in Jesus' name. Amen.
Amen. God bless you.
Amen. Good night.
Pastor Yanka, I said then I'll catch a nyami nipa no. Nyami nshira o.
Nyame nhyira wo.
So may the Lord be with you. I hope it was a wonderful experience. Please
Yes.
go, take your time, don't rush. If you see a question and you know you don't know, skip, go and do other ones. You come back and you still don't know, skip, go and do other ones. You come back. Why are you still coming back? On power sem, join a life, man. Again, it's your on how. Massa, look for other ones who care about you. A question that doesn't care about you, don't